Hi everyone, good morning. It is so good to see you all. Come on. I need to know whether you all can hear me and you all can see me and my screen. So just give me your attendance by hitting the like button or put your attendance on your chat box. Good morning. Okay, that means you all can hear me, you all can see me. I hope you all are there with your pen, paper, calci, everything ready. If not, just grab one fast and come back. Good morning to one and all. Okay. So as we had done the previous two chapters in my marathon, okay, so we are back again with the same positive mindset that we are going to get more than 70 marks. Not even more than exemption, we are going to get more than 70 marks, okay, in this paper. CA and FM. We are doing that FM part, which is 40 marks. Very interesting. We will love solving this, and I am covering today a very important chapter which comes as a compulsory question, which is working capital management. Okay, so pay attention. I will be explaining everything in detail and solving examples of each type of sums like how we did previously. Okay, so I had taken a marathon on 6th. Today I am taking it again. We are going to continue with the FM and corporate accounts marathon in the next week. So we still have FM marathon coming up on Friday, and then we will begin with corporate accounts on 13th, 15th and 17th. Okay, so book your dates. Solve with me. I am going to solve the sums. You are also going to solve the sums with me. Understand? Okay, and the dream batch is the gift which I had given you all, and I'm still, for those who are new today, who are attending for the first time, go and take up the dream batch. It is for a minimal amount of 99 rupees, where you have unlimited views on the videos, in-depth videos, the entire syllabus. Okay, so go ahead, start doing the dream batch. It is the right time now. Also your exams are going to come up in a month's time, so you have access to these videos until your exams. Multiple times you can watch those videos. So for that also you can just click on the link which is given in the description and start studying from now. Whatever revision I am doing, yes, of course, that is going to help you fantastically to understand your concepts, to give you the basic practice. You want to have additional practices, you can go ahead with the dream batch. Okay, so we are going to start today. As I said, working capital is the chapter which I am taking up. Working capital management is the name of the chapter. But to begin with, there is something which I have kept on my screen. Okay, so working capital is what? Current assets minus current liabilities. Anybody else can give me what you all understand by working capital? Come on, I want to know. According to you all, what do you mean by working capital? Current assets minus current liabilities, yes. But any other word you have heard about working capital in place of working capital? Come on, think. Give it to me. Give the answers in the chat box. Let me know how much you all have known or you all have studied previously. What is your basic understanding on working capital? Fantastic. Somebody has told me it is a day-to-day capital. Very good. Okay. Capital used for the day-to-day operations of the company, for the day-to-day expenses of the company. Fantastic. Yes. So in a very, very basic language, working capital is that amount of money I need to run my day-to-day expenses. Okay. I should have enough amount in order to pay off my obligations. Okay. So how will I pay my obligations? Only if I will do my business, right? So currently, what are my business incomes in order to pay off my business liabilities? Okay, current. Those liabilities which are current, and those assets, the amount of assets which is there to absorb those current liabilities. So which are the current assets you all know about? Current assets which we will take into consideration to work out with the working capital. What are those current assets? Come on. Which are the current assets which we look at, and which are those current liabilities which a organization has to current assets, current liabilities we know, but which current liabilities, which current assets? Okay, stock, cash, debtors. Very good. These are the three most important assets: stock, cash, debtors. Then all right, liabilities, if anybody can name it, some amount of liabilities. Creditors, bills payable. Fantastic. Outstanding expenses. Yes, superb. Okay, so according to me, you all have a basic understanding of what is working capital, what is current assets, what is current liability, because the entire chapter is revolving on all these topics only. Okay, the entire chapter. If you have your basics clear of working capital, you will be able to attempt the questions asked. Okay, so go ahead, share the link of the dream match with your friends in other groups. Let them also take this advantage of studying now and clearing the exams. Okay, so share with as many people as you all can, and help us to reach out to them. Okay, so beginning with working capital, current assets minus current liabilities. Okay, but why are we studying this chapter? Okay, why? Because we have to manage the working capital in a given organization. The most vital decisions taken by an organization is to know how are they going to manage their day-to-day expense, their day-to-day payment of liabilities. How are they going to go about with it? That is the most important short-term planning which has to be done by the management. Okay, for that they need to ascertain that how much are they going to need, what is their working capital requirement, are they able to do that, pay the liabilities with the in-house available current assets, or will they have to go to bank, take a loan? What has to be done to keep yourself in that positive working capital? Okay, working capital is a very, very important uh, management decision. Why? Because that is only going to help you run your business. Okay, and it will stay as an ongoing concern. We will come to know about a liquidity position, whether we have that much of liquid cash. Okay, so our liquidity position is also ascertained with the help of working capital. So to understand, whenever we are doing current assets minus current liabilities, we are talking about net working capital. Okay, gross working capital and net working capital are two important terms: gross working capital and net working capital. Net gross is the total current assets available with us. Okay, total current assets. Net working capital is your current assets minus current liabilities. It can be positive, it can be negative. When will our working capital be positive? Obviously, when your current assets are going to be greater than current liabilities. And when will it be negative? When your current assets are less than your current liabilities. Means you're not able to fulfill your obligations with the help of the current assets you have with you. Correct? Okay. So now let us understand why are we having these different motives, okay, of holding amount of cash or holding an amount of capital to fulfill these obligations. First one is your transactional motive. Okay, I am doing the theory concepts also which can be asked in your exams. Mostly working capital, they are looking at practical point of view. They are giving you questions to solve. It is for both old and new syllabus. Okay, I will be solving all the big sums. That is only going to help you solve the MCQs. In fact, I have kept certain exam MCQs which you will know that though they are asked in an MCQ format, you have to solve them in order to get to that MCQ answer. So unless you do not know how to solve a particular question asked in detail, you are not going to be able to do your MCQs. Okay, so this is for both old and new syllabus. Okay, stay with me and pay attention. I may ask any question. Okay, so this is the most essential motive. Okay, transactional motive of ascertaining the working capital. What is the transactional motive? Basically, it is for holding cash because cash is the medium through which all the transactions of the firm are carried out. Without cash, nothing is going to happen. Okay, like we need to purchase, say, capital goods like plant machinery, we need raw materials and other components, we have to pay rent and wages, we have to pay for power, telephone, freight, courier, etc. Okay, so the transactions are paid from the cash pool or the cash reservoir which has been there with the organization. Okay, so capital inflows can happen with the help of promoters capital, or we can do the borrowed funds. This is all what we talk about in financial management, right? Own capital, borrowed capital, then sales, turnover of the product which you are dealing in, capital gains from the investments which the organization has made. Okay, so one important motive is your transactional motive. Second is your speculative motive. Okay, since cash is the most liquid form of asset, means it is readily available in cash. Other assets, other current assets, they are though current, but you have to convert them. They are not that liquid, right? Like stock, they are not liquid. All right, you have to kind of sell that in order to convert it into cash. It has maximum potential of value addition to a firm's business. The value addition can come in two forms. First, as the originating and terminal point of the operating cycle, cash is invaluable. But, okay, originating or terminal point means from where it is starting and where the operating cycle is ending, that cash is not valuable. But cash has an opportunity cost. Means if you take up, say for example, you have 10,000 rupees. Okay, so yes, cash is a liquid asset. You have that, there is a value. But what if you have kept that cash in your cupboard for months? But that same cash, if you would have put it in some FD or you would have done some investment, would have not generated some kind of an opportunity for gaining money. So that cash which is kept for some other purpose and not utilized for A or B purpose, that is known as an opportunity lost, opportunity cost. Say that same 10,000, I had two opportunities. Okay, I had A and B. Either I invest in project A or B. So if I am investing that 10K in project B, there is an opportunity cost lost over here. I could have invested in this. So there is always, this is always going to be there. Okay, so the Cash which is kept aside or idle, it becomes a liability rather than the asset. Okay. Therefore, efficient firms seek to deploy surplus cash in short-term investments. Short-term, keep it for short-term. Whenever you want, you can sell it. It is easily marketable securities. Okay, not long-term, short-term securities. And you get better returns also. It is here that the second form of value addition from cash can be had. Since this deployment of cash needs to be done skillfully, not all the firms will do this. Not everybody does the investment. Not all the organizations. Okay, there are very few organizations who will go ahead and keep these short-term investments. And the last one is contingency. Contingency means that is that kind of event which may or may not happen. It is though associated with the business, but it is uncertain. You really don't know tomorrow you might need that particular amount of cash for some emergency purpose. You did not know it. Cost of raw materials went high. Labor is asking for more money. Okay. The amount at which you were selling your goods, the prices have dropped. Okay. So for such contingencies, you have to keep the cash. Okay. Now quickly moving with the types of working capital. Two important types I told you all, gross and net. Now there are other. Initial working capital. Initial working means at the time when you commence the business, the amount required, okay, for your preliminary expenses, your promotional expenses, you took an office, you paid rent, etc. That will be your initial working capital. Regular working capital will be the one which you need regularly for day-to-day business, as you all only gave me this answer, right? That is the regular working capital. Next is fluctuating working capital. Okay, sometimes due to the seasons, like right now we have mango season, correct? So certain organizations or small companies also who are running this business, their working capital keeps fluctuating. Over the year, they may not need any working capital as such, but at the time of the season they need it because they are selling it on credit, they are purchasing it in advance, they are storing it. Okay, so all that matters. Okay, so there can be a fluctuating working capital that depends upon the seasons. Then reserve margin working capital. Okay, it is that margin which you keep aside. Okay, whenever you have, like, you know that the company needs a working capital of 10,000, you say no, add a little bit of 10% contingency on this, so now it will become 11 rupees. Okay, instead of 10 you add some contingency and you will say that no, this is the amount. You always keep a little higher amount for your cost, right? Similarly, it is reserve margin of working capital. Permanent working capital and temporary. Again, temporary is something when you need it only at the time of given season, etc. And permanent, it is always going to be there. Okay, a process which is continuous in nature. Okay, regular supply of working capital is needed. Then we have is long term working capital. It is to have that working capital to meet the company's needs even when the demand, okay, is at the lowest point. Means what? That the demand of the company's product may keep fluctuating up and down, so you need to have a long term working capital. Okay, here, so if the demand is declining, obviously you will have to store your products. Storing of products is another cost. Okay, so because of that you need long term working capital. The cycle of the working capital is really long. Why? Because the goods are getting manufactured but they're getting stored, so therefore there is no sale. No sale, there is no debtors. No debtors, no payment. Okay, so your operating cycle is really long. Short term working capital. Short term working capital, it is directly variable to the level of activity you are doing in a organization. Okay, short term. Okay, like from cash you took raw materials, from there you, if in case you are into manufacturing, or from cash you bought inventory, you sold it to the debtors, and then from debtors again back to cash. So there can be long working capital or there can be a short small working capital. And gross working capital is your total current assets. Net working capital is your current assets minus current liabilities. Okay, so in this chapter basically what are we studying is we want to manage it. We want to manage our working capital. So say we need cash. Okay, Why? Because we wanted to buy raw materials. Now that raw materials will go, and when we start producing it, some amount will be in work in progress, not together everything I will make, no. Then some will turn into finished goods after that. Then I will be able to sell it. So there will be debtors over here. Okay, bill, because I am selling it on credit. So there will be bills receivable in future. They are going to make the payment to me. And then once the payment is coming back to me, it will be cash. So this is your working cycle. Okay, operating cycle. Now yes, obviously not all the raw materials I will take in cash. So here I have my creditors who are going to give me raw materials on credit. Like how I am giving credit facilities to my debtors, my creditors will also give me my facility for making payment at a later date, right? So this cycle is known as the operating cycle. This can be long, this can be short. Okay. Okay. Now there is something known as factoring versus accounts receivables and loans, and factoring versus bill discounting. Okay. Now we all know what is bill discounting. You have a bill as a, I am a seller. Okay. I am a trader. I go ahead and I have generated a bill of 10 lakh rupees. I go to the bank, I discount it. What will bank do? They will cut some 10-20% and they will give me the amount. And then they will follow up for that bill. Right. This is what is basically bill discounting or account receivable loans. But there is a factoring, which is again a service provided by banks. We will do a practical problem based on factoring and then we will come back to this. Okay. Then there are sources of financing working capital that will differ depending on what type of working capital you need. Okay, so sources for permanent working capital will be own funds. Permanent, you keep needing that, so own funds will be your main source. Okay, like equity, preference, etc. Another is bond financing, term loan from banks, and short term borrowing. Okay, is also a source of working capital. Source of variable working capital will be trade creditors, bank loans who give overdraft facilities, commercial papers. Okay, short term money where you are borrowing short term. Then depreciation is also a source of working capital because it is a non-cash expense. Okay, depreciation, like how I told you, if you remove 10,000 rupees and you keep it in your cupboard idle, it is not going to grow. But that same 10,000, if you invest, it will grow and it will help you get liquidity. Correct? Same thing is with depreciation. See, depreciation, we show it as an expense, right? So instead of showing it as an expense of 50,000 and 20,000 and 1 lakh, might as well remove that amount of money aside, put it in an investment. Let that investment grow and become your source of working capital. Okay. So that is why depreciation is also one of the source of working capital. Tax liabilities, deferred tax payments which you have not yet made. Okay, and other miscellaneous like customer has given you an advance, etc. That will become your source. Then determinants, how you determine the working capital, nature of your business. Okay, seasonal or you are running the business around the year. Okay, then what are your who are your customers, etc. Then degree of seasonality, as I told you. Production policies, depending on you are a manufacturer, what are your production policies, whether you are producing everything in house, packaging you are doing outside. So all that policies also depend on how much working capital would you need. Growth stage of your business. Okay, larger amount, if you keep on taking, like expect that larger amounts of working capital will be required to avoid interruptions. If you want to grow, you will need a proper working capital to have uninterrupted growth in your business. Position of your business cycle, positive position, negative position. Okay, competitive conditions in the market, dividend policy of your organization, how much you're keeping as retained earnings and how much dividend you are giving to your shareholders. Size of your business. Sales policies, what are your sales policies, okay, in the industry. Risk factors involved. Okay, so whether the laws which are involved, in a certain risk which is there, demand supply risk is there. If you are into food items, then they get expired very fast. So all that things also you have to keep in mind. So this is basically just to read this, to know what are the different components which affect the working capital. Okay, now as we are talking about current assets and working capital, so briefly I will tell you what we will have to do. We have to manage working capital, right? We are saying manage working capital requirements of the organization. So manage working capital requirements of the organization means what? I will have to manage and see my total current assets. From that, cash, all right, it is there. Cash includes cash in hand plus cash in bank, right? Then I have one very important current asset, that is stock. Then we have debtors, right? So these two are very important. Then we have our creditors as current liabilities. Okay, so payment terms, if I'm talking about liabilities, so then we have to know about how we are going to have our payment facilities to our creditors, etc. Right? So what I have to manage here, my stock cost, my debtors management, all this I have to do well. So we are going to do the sums on each type: stock management, debtors management, then making the working capital statement. Prepaid expenses are also a type of asset, current asset. Prepaid expense, you have already paid for the services which now you will avail, correct? Like how you have outstanding liabilities as current liabilities. Okay, so even prepaid expenses is one type of current assets, but most important to manage is my stock and my debtors. Okay, so starting with stock, inventory. Yeah, type 1. Okay, inventory. Now if I am into direct trading, like I am a retailer, or I am buying in wholesale and then selling in retail, so there I will be purchasing the goods, keeping with me, and then I will be selling it. Okay, that is how the business works. Or I will be purchasing raw materials if I am into manufacturing, then converting them into finished goods, and then I will be selling it. Any which ways, I will have to store goods, correct? So basically I have to manage whatever I am storing. I have to manage my stock, or I have to manage my inventory, right? So now managing inventory involves cost. You will say, we will purchase and we'll sell. No, there is a lot of cost which is involved. What happens is, when I purchase an inventory, I will have to keep it somewhere. I'll have to store it. I have to carry it. No, basically carrying cost is involved. So sometimes it is like, okay, I am keeping the goods for like 2-3 months. I have to pay the rent for that particular go down or something. There is a carrying cost which is involved with the stock. Okay, then there is ordering cost. If I'll keep ordering again and again, then there is an ordering cost also involved. So either I try to save ordering cost and get all the goods at once, but if I'll get all the goods at once, I will have to pay for the carrying cost. If I don't want to pay for the carrying cost, I pay, and if I don't want to pay for the ordering cost, I will just kind of order it in once. How will I know which is my optimal level of goods which I should call for or order for? Okay, if I have a yearly need of goods of say 10,000 units, what is the most optimum level that I should order, so that both my ordering cost and my carrying cost are at the least? Okay, are at the least, and it's the most optimum way of ordering that amount of materials or goods or etc. anything. So there is one formula. Sorry, the square root has gone. Okay, it is basically square root of 2 into A into O upon C. Okay, now what is this AOC? A is nothing but your annual material required or annual goods required. O is your ordering cost. Whenever you order, per order there is some cost. Okay. Then carrying cost is always calculated per unit per annum, because of course per unit, each unit has a carrying cost. They occupy space, each unit. So carrying cost is per unit per annum. Ordering cost is at one go. You order these many amount of goods, this will be the ordering cost. And then we have purchase price. Okay, so let us solve one sum and then understand that whether this formula is making sense or no. Okay, see, Blueberry Limited, they are estimating the carrying cost at 12%. So whenever carrying cost is given in percentage form, you have to convert it into per unit per annum. Now how, that I am showing. Ordering cost is rupees 12 per order. Okay, I am writing the given. The estimated annual requirement A, annually I will need 40,000 units. Okay, purchase price per unit is rupees 5 per unit. What is the most economical number of units ordered and how often I will have to place the order? Okay, so when carrying cost is given in percentage, convert that into per unit per annum by multiplying it with the purchase price. Okay, so 5 into 12%, you will get 0.6 per unit per annum. Okay, all the inputs of the formula are there. Come on, now write EOQ. EOQ is nothing but, and these questions are asked in exams. They are easy and they are asked, so you have to solve. Okay, so you will do square root of, I am doing basic multiplication with you all. See, 2 into 40,000, oh they have given me 12, divide by 0.6, it will come to 16 lakh square root, so that is going to be 1265 units. Economic order quantity should be 1265 units. Okay, so first answer is given. Economic number of units you should order in one go. So now how many such orders I will have to do? Simple. Number of orders, how much I need annually, upon my EOQ, 40,000 divide by 1265. That will give me some 32 orders. I'll have to place orders 32 times. Okay, so basically if I am placing 32 orders in 365 days, over 365 days, then one order will be placed in how many days? 365 divided by 32. Approximately every 11th day, after every 11 days. Right, 32 times I will have to place the order. I have solved one more thing in that. Okay, at least after 11 days you will keep placing one order. Only at this units and at this number of orders, your cost to store the inventory or order that amount of inventory is going to be at the least. Okay, clear here? Come on, next question. T Limited requires 2000 units of an item annually. Cost per item is rupees 20. Cost per item means purchase price. Ordering cost is rupees 50. Carrying cost is 25% per annum. Find the optimized lot size to be delivered. I am keeping this question on the screen. I want you all to solve and give me the answer. What will be the EOQ? Come on. Please solve this. 2 into A into O upon C, and then give me the answer in the chat box. Some involvement even you all should have, no? Wow, somebody has answered 11 days before I solved it. Akshaya. Great. Come on. Solve this. And put the answer. Let's see who's answering first. Superb. 200 units. Come on, others. You all told me you all are ready. Easy, no? So simple this was. So I know how to manage my stock. Only one person has answered. What are you all doing? Good. Superb. Very nice. Come on, you have some water or something and start solving fast. This is going to be a long lecture, okay? Working capital is the most vast chapter, okay? It's an important compulsory question. So you have to be there with me for all this time now. So solve, even you all will feel a little confident, right? Superb. Everybody is getting this answer. I hope you are not copying. Chalo. Square root of what you will do, 2 into A is how much? 2000 units. O is already given to me 50. How much did you all get? C? It is 5. 25% of 20. Okay, therefore the answer is 200 units. Carrying cost, you have to convert it per unit per annum. That will be 25% of 50, which is 5 per unit per annum. Clear? Okay. Chalo. Simple it was. Very easy. So stock I know how to manage. If questions asked, we will be doing certain exam questions also. You want more detailed analysis, I told you. You have access to my dream batch. Working capital, I have taught in the same manner with more sums. You want more practice, kindly go ahead, take it up, start doing it immediately once this lecture is over. So your chapter is done, you are finished. Like, you don't have to go back to it until your date of exam. You have time for the other subjects then. Understanding? When you're solving with me, you're already practicing, and then some other more important practices you need more detail, you can just watch those videos. Chalo, next one. Type 2, debtors management. Okay, now basically this is to evaluate how much credit period should I give to my customers. Should I give them 15 days credit? Should I give them 2 months credit? Okay, if I am giving them the credit, should I not give them discount? Should I give them discount and tell them to pay faster, so that I get my cash back, my operating cycle reduces, right? So debtors management is to understand that what should be your most best method, okay, of giving the credit. How much credit should you give? Now see this. Okay, as I told you, opportunity cost. There is some opportunity cost which is involved when you are not getting that money utilized to grow. So if my money is spending with my debtors, right, I don't have that money, so that is my cost now. It involves some cost. If that same money I would have put it in FD and or in investment, I would have generated returns. So here how will I come to know what is the opportunity cost involved? Simple, there is one formula. We take opportunity cost calculation, we do it on total cost which is there in our organization, variable as well as fixed cost. I will show you all how to solve and how to calculate that opportunity cost. Opportunity cost in various sums, they will name it as a pre-tax return, cost of funds, cost of investment, cost of capital. Same thing, no? Either what was your cost of funds which are there with debtors, what is the cost of capital which is there lying with your debtors. Same thing, pre-tax return on investment. If you would have invested, you would have got that much of return. So these are the terms which they use when they're talking about opportunity cost, which is blocked with the debtors. Okay. So let us read one question and then we will solve it together. See, they have given us present scenario of an organization, then option 1 and option 2 they have given. Currently, credit period which they are giving is 30 days. They have written no days. Read properly. Sales is 10 lakh rupees. Bad debts, of course it's going to happen, 5%. Cost of administration, admin expenses is 20,000, not rupees in lakhs. It is 20,000. Okay. Variable cost is rupees 6 lakhs. Average collection days is 45 days. Though I am giving a credit period of 30, then also people are paying me in 45 days. Okay, nobody is paying on time. Right. So now they are saying two options they have come up with. They are saying credit period we give 21 days. In that what is happening is sales is going a little down by 9. It's becoming 9,60,000. Bad debts also are reducing 3.33%. Administration cost is reducing 12,000. Variable cost is also 5,72,000. Sales are reducing, variable cost of course. And here now my average collection period is becoming 31 days. Then there is an option 2. They are saying if we are giving more credit period, our sales are going high, 12 lakhs. But then again, bad debts are at the rate of 6%, administration expenses are rising, variable cost will rise, and average collection period is now becoming 72. Clear? Now, why does this average collection period differ from the credit period? Because all the debtors, they are not adhering only to this collection period. Okay, so they are saying assume 1 year is equal to 360 days. The firm requires 20% per annum pre-tax return on investment. That means they are talking about the opportunity cost. Opportunity cost. You are required to suggest which credit period is suitable to the company. Fantastic. Very good question. Come on, let us solve together. Okay, let us solve it. Question number 2. Write down particulars. How will we come to know which one is the best? I will give you a statement to be made. Okay. In that statement, whatever is your net benefit, the highest net benefit your organization is getting, obviously, wherever you will going to benefit, you will use that option. Okay. So let us first see present. Then we will do option 1. And you all are going to do option 2. Okay, I will help you do option 1. I will do the present. I will also do option 1. Option 2 you are going to do it. And you will do it now and give me the answer. Okay. First particular. First thing, make the income statements. Income statement says sales minus variable cost minus fixed cost. This is the income statement you are going to make for debtors management. That will give you gross profit. From gross profit, subtract your bad debts. Okay. Then also subtract your administrative expenses, admin expenses, your P&L related expenses which are there. Then if in case you are giving any discount to your customers, even that is an expense. Discount given is an expense. Okay, so all this will give you net profit. This is it in the income statement. Okay, you don't have to worry anything else will be asked. This is what you need to know. Net profit. Okay, but there is one cost involved over here, which is your opportunity cost. So you will minus it, opportunity cost, and then from that net profit, when you will minus it, you will get your net benefit. Okay, clear? So last we will do the opportunity cost. Rest everything we have with us, no, we will just put it from the given present. I am doing the present. So we have sales, then we have variable cost. There is no fixed cost. So sales and variable cost 10 lakhs and 6 lakhs. Come on. So in case of the present, sales is 10 lakhs. Variable cost is 6 lakhs. There is no fixed cost. Therefore, my gross profit is 4 lakhs. Okay. Now, bad debts is what? How much percentage they have given me? 5% in present. Okay. So, 5% of what will I take? My bad debts. What do you think? You should take 5% of what? Sales, no? Bad debts will be on what? Gross profit. Sales. You're selling, so there are bad debts on that. So bad debts is on sales. So in a first it is 5%. So it is 50,000. Then they have given you some administrative expenses of 20,000 in your first present here. Administrative expenses is 20,000. Okay. So I have come to, there is no discount in this. So my net profit is going to be 3,30,000. Clear? Now I need to know my opportunity cost. Remember, opportunity cost we are doing it on total. Of total means total cost, variable cost plus fixed cost. In our sum, there is no fixed cost, but if in case it would have been there, we would have taken it on the total cost. So how do you calculate opportunity cost? Working note. Okay, for your present opportunity cost. The formula is variable cost plus fixed cost. Okay, into your average collection period. So variable cost and fixed cost, put it in bracket. Then your average collection period. Into your pre-tax rate of return, whatever they have given, rate of return. Right? So let us go back to the question and see what it is. All right. See. Your average collection period for your present is 45 days. Though your credit policy is to give 30 days credit, but they are all paying, your collection is happening in 45 days and they have told me to take 360 days as a year. Okay. So 45 days is a collection period and pre-tax rate of return, they want 20%. So in any scenario, it is going to remain 20%. Okay. So here, what is the amount of variable cost? 6 lakhs in my present. Average collection period is 45. They told me take 360 days, assume that to be 1 year. Obviously 45 days in a year, no? So divide that by 360. The rate of return is 20%. Come on, calculate this. 6 lakhs into 45 divide by 360. 75,000 into 20%. 15,000. Into 20%, which will give me 15,000. So my opportunity cost year is 15,000. So my net benefit in my first option is coming to 3,15,000. Okay. Cool. Next one. Option 1. Okay. Now option 1 also we will just see how much is my sales and variable cost. Sales was some 9,60,000, no? 9,60,000, variable cost is 5,72,000, administration cost is 12,000, bad debts is 3.33% and collection days is 31 days. Okay, so let us solve this here. Come on. Sales is 9,60,000. Variable cost they told is 5,72,000. There is no fixed cost, therefore my gross profit is coming to 3,88,000. Bad debts is 3.33%. Okay, so 9,60,000 into 3.33%, 9168. No, 31968. Sorry, 31968. Then you have administration expenses of 12,000. Discount we are not giving, so my net profit is basically coming as 3,44,032. I need to find my opportunity cost. Okay, so working note for option 1, opportunity cost, right? So it will be again the same formula, variable cost plus fixed cost into average collection period into rate. So the same formula. Now variable cost in my this option 1 is 5,72,000. Average collection period they have given me, it is 31 days, right? So I will do 31 days upon 360 into 20%. They need the same rate of return. So this is now going to be, when you will calculate, it will come 9,851. Come on, see if I am right. 5,72,000 into 31 divided by 360 into 20%. Yes, 9,851 point something something. I have taken it 9,851. Okay, so 9,851. So my net benefit over here will be 3,34,181 in case of option 1. So simple, so easy. Come on, now option 2, you all will solve and give me the net benefit amount. You all will also give me the opportunity cost amount and then tell me, then we will talk about which option is the best. We will evaluate it together. Okay, so please, you all are not sleeping, you all are solving with me. Okay, come on now, solve and put the answers on in the chat box. You all will give me the answer of opportunity cost, what is the opportunity cost, and what is the total net benefit. Come on. 9,851, no, 9,851. Calculate and see opportunity cost for option 1. Now option 2, I will keep the question. Sorry, I'll keep the question on your screen so that you all know. Wow, somebody has already solved it. Net profit is 3,83,000, opportunity cost is 28,800 and net benefit is 3,54,200. Wow, very good. Opportunity cost is 28,800 for option 2. No, net benefit is 3,54,200. See where you all have gone wrong. Have you all taken percentage of bad debts properly? Other things are given. Yeah, opportunity cost is 28,800. Superb. What are others doing? Only 2 people have replied. Good, 3,54,200. Another answer. Very good. You all should not take more than 2 minutes to solve this. Only then you all will be able to complete it on time. Chalo, done. Okay, so this was your homework. Okay, option 2, you already know the answers. Okay, opportunity cost is 28,800 and the net benefit is 3,54,200. 3,54,200. 54,200, no? Yes. And this is 28,800. Alright. So, of course, which option is the best? This, no? This option 2 is the best. Because it is giving me the highest net benefit over here. Though the credit collection period is going to 72 days. But here the sales are also high. Okay, because of which I am getting more benefit. So the net benefit is the highest on in case of option 2. So we are going to do option 2 as our debtors management. Okay. We will just take a 2 to 5 minutes break and I will come back, okay, in 2 to 5 minutes. Meanwhile, if you all have understood this particular sum really well, same statement, same way of solving, I have kept one more sum for practice, okay, which is Gel Corporation. Okay, so you all can try this. Meanwhile, just give me 2 to 5 minutes, I will be back. So solve this. Done? Nobody has even put the answer. Y'all can hear me now? Gel Corporation presently gives credit terms of net 30 days. It has 600 lakhs rupees in credit sales and its average collection period is 45 days. That means they are talking about the present scenario. In order to stimulate the sales, the company may give credit terms of net 60 days. Therefore, the sale is expected to increase by 15%. After the change, the average collection period is expected to be 75 days with no difference in payment habits between old and new customers. Variable cost is rupees 0.80 for every 1 rupee of sale, means it is 80%. The company's before tax required rate of return on investment in receivables is 20%. Assume 360 days in a year. Should the company extend its credit period? How many of you all have solved? And give me the answer. Net benefit for the present one is 108 lakhs. And present opportunity cost is 12 lakhs. Superb. Good. Similarly, how we solved that sum? Question number 3, same, only you have to solve it over here also. Okay, so I am going to quickly do this. Particulars, present and option 1. Present option was 45 days credit. Now we are extending and giving them 75 days average collection period. Here 45 days is the average collection period. Sales, it is amount in lakhs, 600. This is going to increase by 15%. If we do this option 1, so it is going to become 690 minus variable cost at the rate of 80%, 0.8, 80% or 0.8 of 600 lakhs, 480 here, and here it is going to be 552. There is no fixed cost, directly gross profit. So your gross profit is 120, 138. Okay, now there are no other expenses as such, they have not given me anything about admin. They have not given me anything about bad debts. Then there is no discount, nothing, nil. So this is it with my net profit, 120 and 138. Now to this I have to subtract my opportunity cost. Okay, so for opportunity cost it is what? Variable cost is 480 lakhs into average collection period is 45, divide by 360 they have told me, into what is the pre-tax rate of return they want is 20%. So your opportunity cost is going to be 12 lakhs. In case of your option 1, it is going to be opportunity cost 138 into 75 upon 360 into 20%. This is going to be 23. Okay, so here the benefit, net benefit is 108 and over here the net benefit is 115 lakhs. So of course they should opt for this option of increasing the sales and giving the benefit of 75 days of credit. Okay, clear? Good to move ahead. Anybody who is copying, some people are copying also. So here it is. Quickly, 30 seconds I am giving you. Then we need to move to the next type, which is the most important type. Okay, 30 seconds over. Don't worry if in case you're missing it, go to that dream batch. I have solved the same sums. Okay, so it is there, because this is all what is important from your exam point of view. It is there in detail. More sums are there like this. Okay, now question number 5 is type 3, which is the most important type, that is working capital statement. Okay, working capital statement we have to make over here. All right, even if it is an MCQ, they ask you questions based on this statement. Total working capital required with all this information. You have to know how to solve it. Okay, now working capital, as we started the entire chapter in the beginning only, I told you how we will come to know how much working capital we need is your current assets minus your current liability. Simple. We are going to keep this one statement in mind. The moment we will know how much is our current assets and how much is our current liabilities, we'll subtract it. We will come to know how much working capital we need. But in order to understand and how much is my stock, my debtors, my cash, etc., I have to do certain calculations. Okay, so now let us read the sum. The total working capital required I have to find from the following. Production would be 2 lakh units in a year. I have to produce these many units. Raw materials is 60%, direct wages is 20%, overheads is 10% of sales. What is sale? Sales price is rupees 5 per unit. Now they are giving me the duration. They are saying raw materials is expected to remain in the stores for an average period of 1 month before they are issued for production. They are saying in the stores, and then at least 1 month they are there, and then they are put into production. Then raw materials to finished goods production cycle is 1 month. Basically they are talking about work in progress, right? Then once the finished goods are made, they again remain in the warehouse before they are dispatched to customers about 3 months. Credit allowed by our creditors from whom we are purchasing raw materials is 1 month, and debtors are allowed credit period of 2 months from the date of dispatch. 40% of whatever is produced is sold for cash. That means only 60% is credit. 40% is cash, that means 60% is credit. Company must maintain 20,000 cash. They have a bank OD of rupees 25,000, that is the liability. Undrawn profits on an average are rupees 15,000. Additional 10% for contingencies. Okay, undrawn profits on average, and means they have kept certain reserves of rupees 15,000. Okay, now we have to make the working capital statement. Chalo. Let us start. Now whenever any working capital related statement related question is asked, first make the revenue statement and keep. Okay, so see this. Revenue statement will solve half of your problem. Revenue statement. Only then you will be able to solve the working capital statement a little faster. Okay, so particulars. Okay, then there is amount, and there is, this is rupees per unit. Rupees per unit. Okay, revenue statement. In that I first start with particulars. I am doing for 5 lakh units. Okay, I am going to have a production of 5 lakh units, right? This company. So first I start with sales. Selling price per unit they have given me is 5. So 5 into 5 lakhs is going to give me 10 lakhs. Sorry, particulars is of 2 lakh units. Sorry, production is 2 lakhs. I am sorry, I have written 5 lakhs here. It is 2 lakhs. So 5 into 2, 10 lakhs. From there, I will minus my cost of goods sold. Okay, now cost of goods sold will have my material, okay, my labor and the overheads, which are directly variable to the sales. So they have already given me, okay, they are saying material is 60%, wages is 20% and overheads is 10%. Okay, 60, 20, 10. So material is 60%, 20% is the labor and 10% is the overheads, 10% of sales, right? So basically on 5, I will take on 5 rupees, I will take 60% of 5, 3 rupees, then 20% of 5, 1 rupee, okay, and 1% of 5, 0.5. Multiply that by number of units, okay, so it is going to be 6 lakhs. Material is 6 lakhs, 2 lakhs will be the labor and 1 lakh will be the overheads. So when I subtract all of this from my sales, I am going to get my gross profit. Gross profit is going to be how much? 10 lakhs minus 9 lakhs. 1 lakhs is my gross profit. Clear? Revenue statement is made, half of my problem is solved. Okay, only before making the working capital statement. Now, generally what happens is for raw materials, there is not a problem. Okay, whenever we are doing stock, okay, when we do current assets, we are going to ascertain the stock amount, right? So now in the stock amount, raw materials is not a problem, we know. Work in progress is a problem. How are we going to ascertain the work in progress? Okay, so for that there is a formula in that I will show you, but first we will do the working capital statement. Okay, leave some place below this revenue statement, leave some place, okay, some 4-5 lines, and then make the working capital statement. Working capital statement, we have to find current assets minus current liability. Okay, right? Particulars, then make amount, keep the amount column a little big, we are going to divide that amount column, then write the period or duration, whatever, and then write the working note. Okay, so particulars, in amount we are going to do 2 sections. Okay, then we have period it can be small, and then we have working notes. How did we find that particular amount? We will just show it in the note. Okay, come. So now when I start, I will write my first is the current assets. I'll first find all the values of my current assets. In current assets, I will always start with stocks first. Now I will have 3 types of stocks. One stock will be of my raw materials, one I will have stock of work in progress, and one will be finished goods. Always these 3 are always going to be there. Okay, raw materials, work in progress and finished goods. Okay, so now how do I calculate? They have given me the period where how much raw material is remaining, how much work in progress is there, how much finished goods is there. Okay, so let me just find that out. See, raw materials remain in the store for an average period of 1 month. Raw materials to finished goods, work in progress is also 1 month. Finished goods is for 3 months. Everything is given in the question. Just peacefully and with good understanding, you have to write everything properly in given. Only then we will be able to solve. 1 month is work in progress, raw materials, 1 month is work in progress, and 3 months is finished goods. For raw materials, it is very easy. We already found out the materials amount in our income statement. How much it is? 6 lakhs. See here. Correct? Simple. What I will do is 6 lakhs into 1 divided by 12. So this is going to be 50,000. 50,000. For raw material, it is very simple. What about work in progress? In case of work in progress, what happens is basically for work in progress, understand. Work in progress means what? Your 100% of raw material is put to use. But they have not yet become finished goods. Therefore, we take only 50% of our wages, yet certain amount of work is left to be done on that. Therefore, labor is to be applied on that. So say 50% of labor or 50% of wages, and balance 50% of other overheads. This is how I will take the amount in order to calculate work in progress with the given duration. So in my this revenue statement, 100% of raw materials. That means I am taking full 6 lakhs. But then 50% of labor, that means 1 lakh. And 50% of overheads means 50,000. So now based on this 7,50,000, I will be able to calculate my stock regarding work in progress. Okay. So this 7,50,000, I will take it here. Again, they are staying in the store for 1 month. 1 divided by 12. 62,500. Okay. Finished goods, we always do it on cost of goods. Okay, cost of goods sold. COGS. We have already calculated our COGS. 6 plus 2 plus 1. Okay, COGS here. 9 lakhs. Okay. And they are staying in the warehouse for a period of 3 months. Okay, so you all can write your COGS, or directly you can write 9 lakhs over here. Okay, in with pencil just write COGS. So in exam time again you all will sit thinking what is this. Okay, so it is 2,25,000. Clear? Stock is done. Stock is not a problem. Now it is done. This is the main calculation. Stock is the main calculation. Now I am going for debtors. Okay. So 2 important ones which I have to calculate, I will do. Now for debtors, I am giving them a credit period of how much time? First is 40% I am selling it in cash. That means 60% is only in credit. And I am giving them 2 months. Okay, 2 months. So debtors will be 2 months here. 60% of my goods are sold on credit. Okay, 60% of goods. 2 lakhs. Okay, so credit sales. How much is the selling prices? We have calculated in our revenue statement. Credit sales is 10 lakhs. Okay. So 60% is sold on credit because 40% is on cash. So 6 lakhs is on credit. Write down 6 lakhs. Credit sales. Into 2 divided by 12. 1 lakh. So debtors is also easy. credit sales into the duration period, whatever is the average collection period they have given me. Okay, then they have told me to maintain a cash of rupees, they already have a cash of rupees 20,000. Okay, right here cash is there, company must maintain rupees 20,000 as cash, we have written. Bank OD will take it in current liabilities. Now undrawn profits on an average is rupees 15,000. I have nothing to do with that in working capital. Okay, I really don't know what they're doing with that undrawn profits. I have to understand that I will take current assets and current liabilities. Okay, they have not told me this 15,000 is in bank or in cash in hand or something, nothing like that. Okay, so debtors I'm done, cash I'm done. Okay, I'm done with the stocks also. So basically I'm done with 1, 2 and 3. There are any prepaid expenses, if in case, so I'm just writing it, if there would have been, it would come here, but we do not have any prepaid expense. Okay, so A, total current assets is total of all this, which comes to 4,57,500. Clear? Whatever calculation we had to do was for stock and for debtors. There is no other calculation as such. Yes, one only for creditors small, because we are purchasing it on credit raw materials. Okay, so now B, current liabilities. We will subtract current liabilities. In current liabilities, I have creditors. Okay, creditors is there on my raw materials. So raw materials, I know the amount of raw materials, but how much is the credit period? They are allowing me 1 month credit. Okay, so current liabilities, creditors 1 month is the credit period on raw materials. Raw materials is 6 lakhs rupees, correct? So raw materials into 1 divided by 12, that is 6 lakhs into 1 divided by 12, 50,000. Okay, then there is no bills payable as such. We have bank OD, they have given us bank OD is some 25,000. Okay, so B, current liabilities, the total of current liabilities is coming to 75,000, right? Therefore working capital, net working capital, which we say, okay, net working capital A minus B, 4,57,500 minus 75,000, it will come as 3,82,500. Add 10% contingencies as they have told us, so 38,250. So working capital required will be 4,20,750 working capital, total working capital required. Okay, clear everybody with this working capital statement? Do not start with the working capital statement immediately. Okay, try to make this two things, two important notes. One is your revenue statement also is in note format, and your work in progress. Okay, so these two, once you have done, no, your calculations are going to become very simple. Clear? We are going to do one more sum on this, so don't worry. In fact, that, so now the other sum is a little lengthy and more in detail. Everybody with me? Okay. Somebody has mentioned me undrawn profits on an average is 15,000 is a part of current assets. See, there are two things in that. How will I know that the profits which I have undrawn is a part of current assets only? From where has this profit arisen? I all understand this is a half information. What which does not give me a sure shot ascertainment of a current asset. It can be an asset, but whether it is current or no, I don't know. It can be a part of your asset, but your undrawn profits on an average is rupees 15,000. What would you understand by this? Where is it being utilized? Okay, so I will not consider that. Let us go to the next sum. Now the next sum is again type 3 only. We are still doing working capital management only. Okay, I have given you a few formulas over here. Gross profit ratio, net profit ratio, return on capital employed, then return on the net worth or return on shareholders funds. We have already done this, right? In the first video the lecture which we did a marathon. We already know gross profit means gross profit upon sales, net profit upon sales. Return on capital means how much NPBIT am I making to have that capital employed in my organization. Net profit after tax upon shareholders funds will give you net worth. Then return on equity, net profit available for equity shareholders upon the equity shareholders funds. Return on total assets is NPBIT upon total assets. All these profitability ratios on sales and on capital I have just given you all in this, so that we might be using a few here and there. Okay, now same thing again, we are going to do working capital only, but cash cost concept. Okay, cost concept in fact. Now what do you mean by cost concept? There they are saying that whenever you are recording the working capital amount, recorded at the cost price, which are incurred actually in cash. So if you are talking about depreciation and profits etc., then that should be removed. Non-cash items have to be removed. They should not be recorded. Okay, because they are non-cash and they do not have actual cash involvement in it. Okay, even the profits in that matter. So first is they say remove depreciation entirely from work in progress. They might also depreciate, no? Remove depreciation even from finished goods. And whenever you are doing sales, okay, whenever we are doing the sales, do the sales at cost price and not at the selling price. So whatever is your sales, remove the profits, remove the depreciation, and then do the sales at cost price. Now what do you mean by do the sales at cost price? Means debtors. Whenever we are going to calculate the debtors, we will take the credit sales amount, like how we took it in the previous sum. Okay, we directly took the amount of sales, 60% was on credit, and we calculated debtors on that amount. Here they are saying that do not do the debtors in that manner. Do debtors at cost price and not at the selling price. So I will have to find sales then at cost price, right? So sales at cost price formula is that you remove depreciation, you remove any profits, and then whatever is remaining, that you have to use it as sales at cost price. Okay, we will solve it, you all will understand it better. Okay, so they might give you a sum like this. Okay, they tell you, yeah, the debtors are to be calculated at cash cost concept etc. So you have to understand what you have to do. So now see this sum. This is a lengthy sum, we will solve it slowly. X cement company has 5 lakhs drums of cement. From the information given below, determine the net working capital requirement for the year. Cost structure of the per drum of the cement is given as under. Cost of goods, okay, in that they are using gypsum, limestone, coal and packing material. Per unit price they have given me 25, 15, 30, 10. Direct labor is 50. Factory overheads, it is including depreciation of rupees 10, that is total 30. Then there is admin overhead, selling. Total cost is 205. Profit margin is 45. Selling price therefore comes to 250. On that we are adding a sales tax, okay, some amount of tax, 10% on selling price. So invoice price to the customer is now 275. Cost sheet they have given me. Additional information, the holding period for raw materials, there are 4 raw materials. One is gypsum, limestone, coal and packing. So they have given me duration, like gypsum 3 months, limestone 1, coal 2.5 months, packing material 1.5 months. Product processing period means WIP is 0.5, finished goods holding period, and debtors credit is 3 lakhs. Minimum desired cash is 25 lakhs. Current liabilities is 88.49. Add 10% for contingency. Follow the cash cost method. Clear? So now first we are going to make the revenue statement. Okay. With the help of my cost sheet, I am going to make my revenue statement. This is answer number 6. Okay. Answer number 6 we are doing. Revenue statement. Write down particulars. We are going to do it for 5 lakh drums, right? 5 lakh of drums. Okay, amount in lakhs, and this will be rupees per unit. Okay, starting with sales minus COGS. Okay, now in COGS, in cost of goods sold, I am having first material. Now in my material I am having gypsum, limestone, then we are having coal, and then we are having packaging material. Okay, now the sales over here I am going to take it at 275 invoice pricing. I am going to sell this along with the tax whatever 275 per unit. Okay, so sales is going to become 1375 into 5 lakhs. So if you are writing amount in lakhs, just do 275 into 5, 1375. Okay, gypsum, they have given me the cost per unit is 25, limestone is 15, 30 for coal, and packing material is 10. Just let us have a look. 25, 15, 30 and 10 here. Cost of goods. Okay, so amount in lakhs will come as 125, 15 into 5 75, 30 into 5 150, and packing material will be 50. Okay, so in COGS material is done. Now I will do labor second. Okay, labor, they have told me it is 50 wages, direct labor. So 50 into 5, 250. And then they have told me overheads. Okay, factory overheads, that means the ones which are used in factory, but they are including depreciation. Okay, so factory overheads includes depreciation. So from here I will first remove depreciation of 10. So instead of 30, I will write only 20. First I will remove depreciation from here. In overheads, write over here 30 minus 10 of depreciation. Just write it in pencil so that you all know. So here it will be 20. 20 into 5, 100. Okay. Now write the depreciation separately. 10. 10 into 5, 50. Write it down because we are making the revenue statement. Okay. But from overheads I have removed it. I am writing it separately. Total COGS. Total. This 125 plus 75 plus 150, 50, 250, 100 and 50. Total COGS is 800. Okay. This entire COGS. This is entire cost of goods sold. Clear? 800. Therefore, gross profit 1375 minus 800, that will give me 575. Okay. Then I have certain administration overheads and I have some selling overheads also. Administration overheads, they have told me it is 20. Selling overheads is 25. Okay. And then there is a sales tax. Okay. 10% of the selling price. Now here sales tax 10% of selling price. They have given me 25. That means they are considering this selling price obviously. Only then the invoice will become 275. Correct. So sales tax is 25. Selling overheads is 25. Administration overheads is 20. I am taking everything from the question. I am not making anything over here. Multiply that. You will get 100, 125, 125. Okay. Here you are going to get net profit before tax. NPBT. It is equal to be 225. Okay. So this was my first working note, my revenue statement with the help of the cost statement which they have given me. Now next I am keeping the working note for WIP ready. I have told you it is WIP, we will calculate on 100% on raw materials plus 50% on wages or labor and 50% on overhead. Okay. Obviously factory overheads, that is only directly variable to sales, that is only used in work in progress. Okay. So 100% of raw material I calculated, it was total 125 plus 75 plus 150 plus 50. All four, gypsum, limestone, coal and packing material here. Total. This total. It is 200. Sorry, it is 400. Okay. So 400 of raw material. Labor, I am going to take 50% of the labor. So labor is 250. I am going to take 50%. It is going to be 125. And 50% of overheads. Overheads is 100. I am going to take only 50 here. So this is going to be 575 lakhs. Based on this, I will do the calculation of WIP in my working capital statement. Clear? Come on. Now the next one. For finished goods. Okay, for finished goods, I am doing cash cost concept. I have to do cost concept everywhere. So it is going to be COGS. I will remove the depreciation from there. Okay, COGS into that depreciation I am going to remove. So COGS total we just found out was 800, right? Remove depreciation 50 from there. That is going to be 750. I'll do calculation for finished goods on this 750 lakhs. Okay, and the third, debtors. Debtors also same, cash cost concept. I will do sales minus depreciation minus NPBT, and based on that I am going to calculate as per average collection period. Okay, so sales is how much? 1375. 1375. From that I am going to remove depreciation of 50 and NPBT 225. Okay, so 1375 minus 50 minus 225, 1100. Okay, so on 1100 I am going to calculate my debtors. So now when I will make my working capital statement, it is going to become very simple. Okay, I'll be able to calculate faster. Come on. So now we'll make this statement, working capital statement. Same like how we made before. We'll write particulars. Amount column, keep it big, and then make 2 bifurcations in that. Then you can write your duration and then working note. Okay. Come on. Current assets minus current liabilities, that is what we are going to do. Same thing like how we did in the previous sum. Okay, current assets. Start with current assets. In current assets, first I will finish with my stock. Okay, in stock I have the stock of raw materials, I have stock of WIP and stock of finished goods. Okay, so in case of raw materials I have gypsum, limestone, coal and packing material. Right, the duration I will just write it down: 3 months, 1 month, 2.5 months, 1.5 months. They have given me all this here. Gypsum is for 3 months, limestone 1 month, coal remains in the store for 2.5, packing material 1.5. Okay. Right. So I am just going to take their amounts and simply multiply that by the duration. I have already calculated the amount. So gypsum was 125 into 3 divided by 12. Limestone was 75 into 1 divided by 12. Coal we calculated was 150 into 2.5 divided by 12. And packing material was how much? 50. Take it from the revenue statement. Packing material was 50. Okay, here. into 1.5, no? 1.5 by 12. Okay, so when you will calculate this, this will be 31.25 lakhs, 6.25 lakhs, again 31.25 lakhs, and then 6.25 lakhs. Okay, so for stock, raw materials is done. In stock you have raw materials, then in stock you also have WIP, work in progress. Work in progress is 0.5 months they have given me. I have already calculated the amount which we have to take for work in progress, right? Here 575 lakhs we are going to do on this. Working note 1, 575 lakhs. Okay. So 575 into 0.5 divide by 12. Okay, that will come up to 23.9583. You all can even round it up. Alright, 96, you all can make 23.96. Work in progress. Finished goods, they are saying the duration of finished goods in the stores is 1 month. For finished goods, the amount is 750. Cash cost concept, okay, COGS minus depreciation. So I will do it on 750. $62.5. So all my stocks are over. Right, then comes the debtors amount. Debtors amount also I have calculated. See, 1100. Nothing, no, they have not given me any information of credit, sales, etc. and all that. Here, nothing has been given to me that this much is in credit or this much is on cash. Nothing is given as such. They have told me to do the debtors also on cash cost concept. So I have found out the amount for debtors which I will be using. So debtors will be at cash cost concept, means sales minus depreciation minus NPBT. So on 1100, I am going to do my calculation. They are going to pay me in a period of 3 months. So 1100 into 3 divided by 12. This is going to be 275. And cash, they have already given me the amount 25 lakhs. Okay. Therefore, current assets A is going to be how much? Total of this, total of stock, debtors and cash comes to 461.9583. 4583. 4583. Okay, and in current liabilities, they have already calculated the current liabilities and given it to me. Okay, B, 88.49. Therefore, net working capital, that is A minus B, is coming as calculated, it is coming as 372.9683. Add 10% contingency as they require. So I am going to add 37.29683. So total working capital required here add this, the final answer is going to be 410.26513 lakhs. Amount in lakhs, don't forget to write in the paper. Amount in lakhs. If you are doing the calculation like this, please don't forget to write that. Amount in lakhs. Clear? Okay. Everybody with me? Calculated with me? Come on, 30 seconds. I am giving you all time to copy this working capital statement. Clear? Everyone good to go? Can we move to the next question? Yes, of course, you all can round it off. You all can round it off in the starting also. Up till 2 decimals you all can do it. Okay. In MCQ papers, if you are attempting that, then you have to find out the nearest answer which they are asking. You will be able to do that. There will not be a problem. And for the entire solving paper, yes, you all can round it off. You all can write approximately. Good to go. Come on. Now we are going to do something known as operating cycle. The circle which I had showed you all, remember? I told you that if I have money, I am going to go and buy my raw materials. With that, I am going to make certain goods. Therefore, then that goods will be in work in progress. Then they will develop as finished goods. I will sell it. I will generate debtors, and then I will get my cash back. Okay, so operating cycle is nothing but that is the duration of your conversion of money, from the time you spend it till the time you get it back. Okay, so it is very simple. Operating cycle is the time period for raw materials, for work in progress, for finished goods plus debtors, and minus the period you get from creditors, because that you are getting, so that your operating cycle will reduce by that many days, because even the creditors are giving you 30 days, 45 days credit period. Okay, so the time required to complete one cycle as above is called the duration of the operating cycle. Now if they are asking me to find the duration, how will I find? I'll have to find the duration of each of this component. Duration for raw material, duration for work in progress, fixed goods, debtors and creditors, and I will be able to then calculate the amount of working capital required based on the duration of my operating cycle. Okay, so two things get covered here. First, you will be able to find the duration of operating cycle. You will also be able to find the working capital required based on the length of your cycle. Okay, so now first we will just go through the formulas, easy to remember. Okay, when you are doing raw materials holding period, it can be 12 months, 365 days, 52 weeks, whatever. I have taken as per year, so 12 months I am taking as per months. Okay, so I want to find raw material holding period. I will take average of raw material, opening closing, divide by 2. Average is always, what is average? Opening plus closing divide by 2. If nothing is given in the question, I will directly take the amount of the raw material. Okay, upon cost of raw material into 12. Then WIP, I will take average WIP. Everywhere it is average. In the numerator, everywhere it is average of that component which we are finding. Average of WIP upon cost of goods produced. If cost of goods produced is not given, COGP. You will take cost of goods sold, whatever is there with us. Finished goods upon cost of goods sold. Debtors collection period, average of debtors upon credit sales into 12 or 365 or whatever. And creditors collection period, average creditors upon credit purchase. These 5 formulas. Okay, and 5-7 mark sum, even if they ask, like totally it is in. Yeah, so amount of working capital required, sales into the duration of your operating cycle divided by 12. Okay, now let's see. A note, for raw materials we will take the purchases cost, of course. For WIP we will take cost of goods produced. For finished goods we will take cost of goods sold. Let's solve one sum and understand. Okay, compute the duration of operating cycle for each of the 2 years and comment to increase and decrease. Assume 360 days in a year. So instead of 12 I will take 360. Simple, nothing much to, I will, instead of 12 I will take 360. So now let's do this. Rupees in 1000, year 1, year 2. Okay, we have to find the operating cycle. They have given me stock, all 3, raw material, WIP, finished goods. They have given me purchases cost for both the years, cost of finished goods, sales, debtors and creditors. Okay, cost of goods produced is not given. Cost of goods sold can be just taken the same, Okay, if nothing else is given. So now let's solve this sum. I will be doing year 1. You all will do the year 2. Okay. So write down particulars. Year 1. Year 2. You all will give me the final answer for year 2 after calculating everything. Okay. Come on. First, raw material holding period. Okay. So raw material holding period. I am writing the formula also so that we can revise it. Okay. Average of raw materials upon the cost of raw materials. Now in my sum it is not 12, so they have told me to take 360. Assume the year is 360. So now average of raw material year 1, it is 20. Average is opening plus closing divided by 2. Nothing is given, then I'll directly take the amount of raw materials. The cost of purchases is 96. Okay. So for year 1, I will do 20 upon 96 into 360. So this is coming to 75 days. Raw materials holding period. Second, work in progress processing period. Okay, so average of WIP upon cost of goods produced. If that is not given, cost of goods sold. Here I will do 360 as they have told me. So average WIP they have given me 14 and cost of goods produced is 140 here. Cost of finished goods, cost of goods produced, and here this is 14. 14 divided by 140 into 360. So this now will be 36 days. Work in progress processing. Third, finished goods holding period. Average of finished goods upon COGS into 360. So average of finished goods, they have given me the finished goods amount 21. COGS is 140 into 360. That will give me 54 days. Okay. Next, debtors collection period. Debtors collection period. Average of debtors upon credit sales into 360. What is the amount they have given me? Debtors is 32, sales is 160. Debtors is 32, 160 sales into 360. Debtors collection period is coming as 72 days. Fifth, creditors payment period. Okay, creditors I am writing payment period, or creditors collection period also you can write, because for them it is collection only for creditors. So average creditors upon credit purchases. Now here they might not give you these credit purchases etc. So whatever amount they have given, we are going to write into 360. Don't forget. Average creditors is 16, purchases is 96 only. That only I am going to take 360. This is coming as 60 days. Okay. So based on all this, my duration of operating cycle in case of my first year is R plus W plus finished goods plus D minus C. R was 75, W came to 36, F we calculated was 54, debtors is 72, creditors is 60. This is coming up to 177 days. That is my operating cycle. Okay. Therefore, amount of working capital required. What is the formula? Sales into the duration of operating cycle upon, in my sum I'll do 360. So here the sales is 160, operating cycle is 177, divide by 360, that will come to rupees 78.77667. I'll just round it up. Okay, 78.67. Clear? That will be my working capital required. Amount of sales which I am generating and how much time I am taking to complete that one cycle of my operations. Divide by the year 12, 360, 52 is in case of weeks, whatever. Okay, so this will be the working capital required based on my operating cycle days. Simple, no? The sum is so easy. Rupees is in thousands. So when you are writing this final answer, no? Amount required for working capital. So this is in thousands. Okay. Now second year, you all are going to solve based on the same formulas. Okay, I am directly going to give you all the answers later. So based on the formula, you all are going to solve this question number 2. I am giving you all the question in front here. Everything is over here. Okay, year 2. Come on, solve this. I am giving you 2 minutes, 2 to 3 minutes to let me know what is the duration of the operating cycle. It is very much applicable for old syllabus also, very much. Okay, in fact you all have many MCQs on this if you all have ever seen your past exam papers. Whoever has not prepared this before also and are starting today, I am sure the way I am teaching, okay, each type with each step, you all think you all will not be able to solve it. I am teaching it like from the basics, like everything I'm covering. Whatever is there in my dream batch videos is just additional sums to the same type. Okay, I am doing it in a manner wherein you do not have to do any kind of other revision. This is enough. If you all are going to study well from what I am teaching you and you're going to solve this, may it be an MCQ paper or may it be a full written paper, it is going to help you solve. I'm solving full sums. Okay, I have done same thing when even the syllabus was in form of MCQ. There is no shortcut to practical questions. Okay, working capital required for this second year is 110 lakhs, right? Correct, 110,000, not lakhs, it is in thousands, no? So you're only all right in beginning, only make it in thousands, or else in the last you all convert it into thousands and then write it. Okay, so 1,10,000 basically. And what is the operating cycle? Acha, you all have already answered. 198, right? Operating cycle is 198 days. Sorry. 198 days. And working capital required is 110,000. Okay. Now I am moving to the last type of this chapter, which is factoring. You remember in the beginning I told you all that we will read that factoring later. First we will solve an example for you all to understand and then we go back to the theory. Clear now? So let us read one question on that first. See, I have given factoring in simple words again. What do you mean by factoring? Okay, now this is a basically package services which the banks give. Okay, what do banks tell you? That you sell your your debtors, whatever amount of debtors you have total, you sell it to us. Okay, we will give you some advance payment on that. We will deduct our fees, interest, commission, etc., and we will give you the whole thing in advance. Okay, so then that I can use now for my other process, again for buying new goods, again for selling, instead of waiting for that 75 days, 60 days. Okay, so then they use this type of services, okay, from the bank. So it is an outright sale of receivables. It is a package service given by a bank to the seller of the goods. Now what this service includes, they give you potential customer development, immediate finance is given to us, doing administration and collection of debtors. The factoring services only will do it. You don't have to run behind your debtor. Correct? So there are two types of factoring, either recourse and non-recourse. What do you mean by recourse? Simple. If there is a bad debt, company will bear it. The bank, the factoring service bank will not bear it. And non-recourse agreement, if you are getting, that means whatever will be the bad debts in future, bank itself will look after it. They will never come back to you saying that these are the bad debts. Understand? So how do you calculate the amount of the due, or how much they are going to, how a bank's going to calculate that how much they should give you in advance? Okay, so whatever are your credit sales, from that they keep a reserve, because tomorrow if some bad debts also may happen. We have to do the processing also from the debtors. We also have to wait, no, for them to come and pay. If I am a bank, you are coming and you are selling me your debtors, I will tell you, I will not give you full debtors amount, 10 lakhs or 10 lakhs I will not be giving you. I will cut the reserve and balance I can give you. Then there are also certain commission and interest amount which is charged by the bank as their fees. Okay, so let us understand recourse and non-recourse. You all have understood, right? Recourse is when bad debts is borne by the seller. Non-recourse is bank itself has to look after those bad debts. Okay, so this is the last type. We are going to solve this sum and then we are going to move to the exam question practice. Exam question practice, though it is looking in a MCQ form, but when I will solve it, you will realize that this can be asked in your exam as a proper solving question. Okay, clear? This factoring type is not that very important. They do not really look after asking this. They might ask you in theory, but I have solved a sum for you to get a better understanding. Okay, see, they are saying sales is rupees 1 lakh, out of which cash is 20%. That means credit sale is only 80%. Debtors will be generated on credit sales. Factor is reserving 10%. Credit period is coming being 3 months. Factoring commission charges are 2% and interest is 1% per month. Calculate the advance amount payable and effective rate of interest if both interest and commission are charged upfront. Only commission is upfront, interest is collected in arrears. Now what certain banks do is, when they are giving you this service, they immediately deduct the commission and interest amount also. 3 months credit period is there, no? So they will immediately deduct the commission and interest, and whatever balance is left from there, they will give you the advance due. Certain banks, they will just deduct commission and interest, they will do it in arrears. Okay, after some time, means as per the period goes. So how do we calculate the amount payable by the factoring bank? So let's do this first. See, question number 8, right? Particulars and amount. I'm just writing the given, nothing much I'm doing. Okay, first one is your credit sales. Okay, based on 1 lakh is sales, out of which only 80% is credit, so 80,000 is credit sales minus the factor reserve. They are saying 10% we are going to reserve it. Okay, so obviously 10% on 80,000 at the rate of 10%. So on whatever is the credit sales, they will reserve this 8,000. So basically 72,000 they will do as an advance due. They will provide you with this 72,000. But now here there are two charges also. One is interest at the rate of 1% and there is commission at the rate of 2%. Okay, so now commission, now basically interest, whenever you will calculate it, you will do it on advance due. Yeah, because interest obviously it will be on this amount for that period, which they have given me 3 months. No, credit period was 3 months. Okay, and commission is always on sales. So if I had to calculate interest, what I will do is 72,000 into 1% into, for 3 months is the credit period, so 72,000 into 1% into 3 divided by, into 3 months, sorry, 1% per month it is already given, 1% per month into 3 months. So that will give me, calculate this, it will give me 2160 per month, 1% per month. And I know my credit sales is 80,000. On that 2% is my commission, that will come to 1600. Based on this, they are saying there are two scenarios. Okay, case 1 and case 2. Okay, there is both these things are there. There is commission and interest. Okay, now commission in case 1, see, any case commission is taken, both the cases they are taking, commission is upfront. They have written, right? First one, both interest and commission is taken upfront. In the second case, they are saying they are taking only commission upfront, interest they are keeping it as arrears. Okay, so in my first case, commission is taken upfront. In my second case also, commission is taken upfront. In my first case, even interest is taken upfront. But here it is kept as arrears, not taken. Later on they are going to take. Okay, so now my advance due, in case first case it is going to change. Okay, it is going to be 72,000 minus 1600 minus 2160. Okay, so it will be 68,240. Again, since the bank is charging me commission and interest upfront, that means I will have to pay now. So whatever advance they are giving me, this 72,000, what I am telling bank, bhai, ye bhi cut do, cut this also, interest commission also deduct only and give me the balance. Simple na itna, very easy. So 68,240 I will get it in my hand, right? Here how much I will get? 72,000 minus 1600. Here I am going to get 70,400 in hand. Both the cases solved. Okay, so your advance due for case 1, advance due for case 2, both is resolved, right? Now they are telling me find the effective rate of interest. What do you mean by effective rate of interest? The compounded rate of interest. When I say, suppose I am having 100 rupees and 3% is the interest on it. Okay, so I am going to make it 103 next year. Again, when I will do 3%, it will be on 103 into 3%. So basically they are asking me an effective rate of interest that has a formula. So effective rate of interest. Rate of interest in case 1. Okay, it will be the interest amount upon advance today. Whichever they have given, what amount of advance today they have given me, in 200. So that is going to be 2160 interest. Advance today I am going to get it 68,240 into 100. So this is going to be 316%, 3.16% for 3 months. Okay, 3 months. Therefore, for 12 months, for a year, it is going to be how much? So basically you will do nothing. You will say 100 plus 3.16%. You will do it 4 times. Why? Because 4 times 3 months, no? That will make 12 months. 4 into 3 is 12. I am finding effective rate of interest. Okay, where principal plus interest becomes the next year's principal. Plus 3.16. Plus 3.16. Whatever answer you will get here, from there again you will minus that 100. 100 I have just taken for making the calculation. So see here. Okay, You will take 100. I hope you all can see. You will take 100 plus 3.16% one time, plus 3.16% two times, plus 3.16% three times, plus 3.16% four times, 113.25 something, minus 100. 13.25 will be your effective rate of interest per annum. Okay, effective rate of interest here. Effective rate of interest. Okay, because of the compounded rate of interest, my effective rate of interest changes. So actually my interest rate is going to be 13.25. Sorry, from here I will just write here minus 100 again, so that you all know the steps. Just put what I have written here, no, put it in your calci, you will get the answer. So it will be equal to 13.25% per annum rate of interest. Okay, once again, I am explaining you all once again. We are supposed to find the effective rate of interest based on both the cases. In my case 1, I am paying interest right away. Right away only I am paying. So interest upon advance today into 100. I will get the percentage which is 3.16, but that is for 3 months. Right. So actually if I want to find for 12 months per annum rate of interest, I will do 100 plus 3.16 4 times. That will make 12 months. No, 3 months and 12 months. So 4 times I will have to do this in order to arrive there. So it will going to be 13.25% per annum. Okay. Case 2. Same thing, I have to find the effective rate of interest. It will be interest amount upon advance today into 100. Interest amount will remain unchanged. Okay, here it is again going to be 2160, though it is in arrears, but it is going to stay. 2160 only is going to be the interest. Advance today is 70,400 in my case 2 into 100. That will be 3.06% for 3 months. Similarly, if I want to find this for 12 months, it will be 100 plus 3.06% for 12 months. I'll have to do it 4 times. 4 3s are 12. 4 into 3 gives me 12. Don't write 100 again over here. Just write plus sign. Write it, Baba, write it, because you all will forget, I'm sure. So at least when you open the book, you also know how this calculation came. Minus 100. When you will do this, you will get something like 12.81%. Okay. So if the bank is giving me the option of collecting the interest later on, okay, it's keeping it in arrears. So for me, okay, as a customer, for me, my rate of interest is actually becoming, effective rate of interest is actually less. Okay, effective rate of interest. Clear, all of you all? So this was the last part of the working capital. Now I'm going to go through the other questions which I have taken it from the past exam papers. Okay, easy ones, they are not that difficult. Just a minute. Okay, everybody, clear? Can you all see me and now hear me properly? There are various scanners, like there is a taxman scanner and Suchita scanner, which they give, in which all past year questions are given. And I have solved all the past year questions which are applicable for you all. Not I've not taken it like from the year 16, 17 and all, but at least from 2000, which is the trend which they continue. So you all can, even if you all solve this much, it is much more than enough. Since you all don't have that much of time of now sitting and solving the scanners, that you all have to do it in the beginning. Getting my point? As and when you all are starting studying, and then each chapter you finish, and then you go to your scanners and solve all the past exam questions. You can buy scanners in which past exam questions are given chapter wise. Okay. Now I want you all also to kind of solve along with me. I am not going to alone speak, okay, and keep doing the work. So you all are also supposed to solve with me. It is a revision of the entire chapter once again with all these questions. Okay, so if you all are able to solve this, hooray, you can solve any question asked in exam. Okay, so this will help you gain confidence. So don't wait for me to solve. Start doing it by yourself. Okay, in fact, you all can give me the correct answers. I might write wrong, so you all have to give me the correct answers. Clear? Chalo. MNC expects its sales to increase by 10% from the current year level of rupees 5 millions with a net profit margin of 8% and the payout ratio is 30%. What financing for the next year will be available from internal sources? First question, and you all will say, ma'am, you have not taught us only this. Now, how many of you all got this thought in the mind? Ma'am has not taught this. Okay, no problem, Baba. This is all based on all the knowledge which you have from all the chapters. The same thing, nothing else. They are asking you internal source means they are asking you your reserves. How much amount is available in your reserves with the help of this amount of sales and profit margin. Okay. As I have always told you, write down the given properly. So current sales is how much? 5 lakhs. No, sorry, 55 million. Okay, so 50 lakhs. Plus, they are saying 10% they are going to increase next year. So it is going to become 55 lakhs. Net profit margin is at the rate of 8%. Net profit of sales. Net profit divided by sales into 100. They have given me the net profit margin. So simple, 55 lakhs into 8%, 4,40,000. Yeah. From that, they are giving a payout. Means dividend. They are paying out 30%. Payout ratio is 30. That means they are keeping with them 70 as internal source as reserve. From this 4,40,000, they are paying out 30 and for 70% will be my reserve. 3,08,000. Wow. That is the answer. First question, ma'am. Different. Arey, we are different. We are CS students. We are supposed to solve this type of sums. There is nothing complicated in this if you don't understand the question. If the question is understood well, given is written and see the answer. Okay. So those who are giving a full-fledged paper, this is for 3 marks. Sure shot. What? There are not even 3 steps in this. And 3 marks they are giving us. See. Next one. Now this though I have solved with you all. Monthly demand for a raw material is 150 units. Monthly demand. Ordering cost is rupees 8. Carrying cost is rupees 2 per unit. They have already given me carrying cost 2 per unit. Now don't try to convert anything. We don't need to. And annual consumption will be what? 150 into 12. 1800. They are asking me EOQ. Solve it and give me the answer in the chat box. Come on quickly. 30 seconds. How nice of you all. You all are writing, ma'am. It is very easy. Thank you for the first sum. EOQ is how much? 30 seconds is over. Superb. 120. EOQ is 120. What is the formula of EOQ? 2 into A into O upon C. So you are going to get 120 units. Nice. Confident. Next sum. Current ratio is 4:1. Net working capital is rupees 30,000. Find the amount of liquid assets if value of stock is rupees 8,000. Okay. Chalo. Current ratio is 4:1. What do you mean by current ratio? Current assets upon current liabilities is equal to 4 basically. So, and they have given me net working capital also as 30,000. I'm just writing the given, nothing else. They are telling me if the stock value is 8,000, find the liquid assets. Liquid assets means what? Current assets minus stock minus prepaid expense. What is liquid assets? Current assets minus stock minus prepaid expense if given. So this is not there only, prepaid expense. Stock is given. We have to find liquid assets. Current assets we don't know. This also we have to find. How? They have given us something. They have given us net working capital. Simple. Based on that we will solve. What is net working capital? Current assets minus current liabilities. With the help of the ratio, I can write current assets is equal to 4 times of current liabilities. Okay. Now working capital is equal to current assets minus current liabilities. Net working capital is given to me 30,000. Okay. Current assets, I am going to write it in form of current liabilities. 30,000 is equal to, just replace it. In case of current assets, write 4 times current liabilities. 3 times current liabilities. So 10,000 is going to be current liabilities. 30,000 divided by 3. Okay. Now current assets plus stock. Minus current liabilities. Current assets plus, no sorry, not current assets plus stock, liquid assets. Since you have got this only, current liabilities we have already got, therefore current assets will be equal to 4 times 10,000. That will be equal to 40,000. Got the current assets. From that I will just remove my stock. Stock is 8,000. So my liquid assets is going to be 32,000. Answer. Working capital was given, current ratio was given. We have to just apply this small thing of converting that ratio as a equation. Current assets is equal to 4 times current liability. Once that is done, you will get current liabilities. You will get your current assets. Based on that, they have given you stock. Liquid assets is the answer, 32,000. Clear here? Moving next. Sure. Wow, this is a cute sum. Nice one. Okay. What will be the operating cycle period if raw materials are in the store for 2 months? Processing time is 2.5 months. Finished goods remain in store for 15 days. Debtors are allowed 60 days credit, and credit received from the suppliers of raw material is 1 month. Operating cycle they are asking R plus W plus F plus D minus C. Operating cycle. Raw materials is 2 months. Processing time is 2.5 months. Finished goods is in 15 days, means I am converting it into 0.5. Half month. Debtors 60 days, that means 2 months. Creditors 1. Add and then subtract. 2 plus 2.5 plus 0.5 plus 2. That is going to be 7 minus 1. That will be 6. What is 6? 6 months is my operating cycle. Come on. Oh wow, again the same sum. Current assets are twice of the current liabilities. If net working capital is 60,000, current assets will be how much? Come on, do it. Current liabilities is coming to 60,000 with the help of this equation. Therefore, current assets will be 2 times of current liabilities. 2 into 60,000. That will give me 1,20,000. Clear? Chalo next. JP Limited has earned 10% return on total assets and has a net profit ratio of 8%. Find out the sales of the company. Okay. What is the return on the total assets? 10%, no? And has a net profit ratio of 8%. And we have to find out sales of the company. Okay. So 18 lakhs. Okay. 18 lakhs is the total assets. So return on the assets, basically the profit, it is going to be 10%. 1,80,000. That is basically the profit, net profit. I have to find out the sales. Okay. So we have this formula, net profit margin basically is nothing but net profit upon sales in 200. Okay, now they have already given me the margin as 8%. 10% was the return on total assets. That gave me NPBIT or NP80 or net profit in that matter. Okay, simple, I'm keeping net profit as per our question. And the ratio of net profit is 8%. That means you're talking with the respect to sales. Net profit amount I know. Sales I don't know. Take sales on the other side. 1,80,000 divide by 8%. Okay, you will get 22,50,000 sales. Simple. Any doubt? Anybody? Any questions so far? Okay. So next. Okay. I'm coming to this question a little afterwards. Next one. Credit. I'm coming to that tandem committee. Credit term is 4/20 net 90. What does it mean? Whenever they ask you anything like this, even in a big question of solving working capital statement, it simply means whenever they give you this 4 by something or 8 by something, that means this first amount, this first number is the percentage of discount. So they are saying the 4% is discount if you are giving the payment within 20 days. Otherwise, the payment period allotted, okay, debtors period allotted is 90 days. Then you don't get any discount. If you're paying in 20 days, you can avail this 4% discount. This is the meaning of this statement. Okay. Chalo, next question. Economic order quantity. Now this I'm not solving. Okay, you are supposed to do it. 1 lakh units. Annual requirement. Carrying cost 10% per year. Please convert this. 10% per year means 20 rupees is the purchase price. No, 20 into 10%. Per unit per annum. Placing order cost is 1000. Cost per unit is 20. Come on, find out. EOQ. 30 seconds. How much is the EOQ? Why no answer? Chalo, EOQ. Easy. 2 into A into O. Square root of 2 into A into O upon C. C I already converted for you all. You all are not solving along with me, then that means. Tandem committee is still remaining. If you all have already gone off to sleep or you all want to exit, I have not yet finished with that tandem committee part. Okay. This is going to be square root of 2 into 1 lakhs into 1000 upon 2. That will come to 10,000 units. Clear? Okay, good. Somebody has given me 1414.2. No, 10,000 units is the answer. Please recheck it. Please solve it properly. Okay. A company has sales of 20 crores and 40% sale is on credit. Expenses on credit collection is 1.5%. The company targets to reduce this collection expense by 40%. Calculate the expense saved by the expected saving target by the company. Very easy. 20 crores is the total sale, out of which 40% is on credit. Okay, so basically 20 into 40%. 8 crore. 8 CR. They are putting this 8 CR on credit. Now what happens is that this collect this 8 CR, they have an expense of 1.5%. So 8 CR into 1.5%. Expense will be how much for this? 12 lakhs. 12 lakhs is the expense. They want to reduce this by 40%. Reduce this means this collection expense by 40%. So 12 lakhs into 40% will give you 4,80,000. So this is the answer. Company expected saving target is rupees 4,80,000 if they reduce this expense by 40%. So first you will find out the credit sales with the help of total sales. With the help of credit sales, you will find the collection expenses 1.5%, and then that collection expense you will reduce by 40%. You will get 4,80,000. Okay. Next question is, a company has raw material holding period of 27 days. Conversion period is 25 days. Finished goods holding period is 28 days. Period for receivable is 20 days and accounts payable is 3/4 of accounts receivable. So 20 into 3 divided by 4, 15. Okay. So it is R plus W plus F plus D minus C. So receivables, they have given to me it is 20. But for payables, it is telling me that receivables into 3/4. That comes to 15. So basically what is your operating cycle they are asking me? It is 85 days. Okay. Sure. Now one small thing, tandem committee. I am just showing you all if in case they generally ask this. Tandem committee. Okay, basically it is a committee set up to give maximum permissible finance. By bank for working capital. If you approach a bank, what all they are going to check from you? First thing, they are going to check your current ratio. They are going to ask what is your current ratio now, how much is your total current assets, how much your current liabilities. Then they will do some working, and then based on that they will give you the working capital finance. But as per this committee, they have kept down some rules and some method of calculating that what should be the maximum finance allowed to this organization. Okay, so there are two methods. Method 1. Okay, in method 1, basically they say that the current ratio of those companies are basically 1:1. Current assets and current liabilities are same. So then in that case, what they say that the borrower, whoever is borrowing from that bank, borrower will have to, arrange for 25% of working capital gap. 75% bank will arrange and give. 25% has to be done by the borrower. This is method 1. So basically 75% will be done by the bank. 75% of what? Of working capital gap. Okay. So say for an example, I'm giving you an example. Total current assets of an organization, of a company, is 4,000, and other current liabilities means all the liabilities other than the financing ones. Okay, the ones used as a finance or loan or long term, all that, some other finances used for working capital, remove all that. Other basic current liabilities, that means without working capital facilities. Okay, without working capital facilities from bank, take only those current liabilities. Okay, so say those other current liabilities is 800. Therefore, working capital gap in my case is going to be how much? 3,200. So as per method 1, 25% is to be taken care by the borrower. So 3,200 into 25%, that is 800. Borrower will take care of this. Balance remains 2,400, that will be given by the bank. Okay, this is method 1. Method 2, with the same example. Method 2 is generally used for those organizations whose current ratio comes as 1.33:1. Here they say that borrower will arrange %25 of total current assets. Okay, 25% of the total current assets will have to be arranged by the borrower. So now with the same example, my working capital gap here is 3,200, right? My total current assets, as I told you, it was how much? 4,000. Okay, in that if I take 25%, okay, which is how much? 1,000. So minus this 25% of total current assets, 2,200 will be the maximum permissible bank finance. Okay, maximum permissible bank finance. In method 2, you will take 25% of the total current assets and then subtract that from the working capital gap. In method 1, you will take 25% of the working capital gap, and balance is the maximum permissible bank finance. Clear? Okay. I hope you all have written this example. If not, I am giving you time. Write it down quickly. Okay, I have kept it on the screen. This is method 2. Method 1, method 2, both I have given. Okay. So I'll come to that question now. Here. Calculate maximum permissible bank finance as per the first method suggested by the Tandem Committee. Now, as per the first method means method 1 they are talking about. In method 1, what are we going to do is, we are going to first take the total current assets minus that from other current liabilities. Okay, I will get my working capital gap. Total current assets will be receivables, finished goods and other current assets total here. Debentures is a long-term liability. Other current liabilities and creditors are the OCL, other current liabilities, OCLs. So OCLs are 200. Okay, and this is 300 plus 500, 800. So my working capital gap is 600. Basically 25% the borrower has to arrange. That means maximum permissible bank finance is 75% of this working capital gap. So it is going to be 450 lakhs. Okay. Clear? Everybody with me? I am feeling so happy. You all are confident. Come on. Then we are going to go on a break now. But before that, I want to hear something positive. Like, are you all confident with this chapter? And I am very happy. I know that I have taken it in the most basic form, and I have completed and reached out to every type. I've not left anything from it, and I want to see that confidence in y'all. Okay, so please go ahead, ask your friends also to join, share this. Please like, share, comment on the videos. Tell me whether this is helpful to you or not. Take up that dream batch. Start solving from that quickly. Since you all already have an idea, you have to just see the sums which are additional ones and try to solve them. Okay. So forward the link for the dream batch also to the people you know, and reach out to everybody, as many as we can. Okay, we have all to get good marks in this paper. We have to actually pass our CS executive, but yes, this paper should like boom up our average. Okay, so we are going to come back again with cost of capital. So before that, we will just take a half an hour break, and then again we resume in half an hour. Okay, so go ahead, take a break and come back. Hi everyone. Took a break. All well, settled. Come on, give me a thumbs up in the chat box that you all are back. I should know. I'm starting with cost of capital. Good afternoon. We shall begin. We are going to do the small topic now, cost of capital, and the important one again. 5 marks must from cost of capital. Chalo. Okay. So this we will finish it a little faster. Don't worry, I will not be taking your so much of time now. In fact, we will do cost of capital. I will solve with all the formulas which are there in cost of capital. We will solve each sum with that, and then some past years questions. And then what I will recommend is, you all want more detailed understanding, more practice of solving these big sums. Go ahead, take up the dream batch, okay, and start solving now. Only today only finish it with this cost of capital. It will get done. It is a very simple chapter. Once you will understand the basics with this video today, then you will be able to solve any sum. Okay, so basically when I am talking about cost of capital again from the company point of view, whenever the company is trying to raise any capital, either it can be in form of own or borrowed, anything, it involves a cost. Even for equity shares or preference shares, there is a cost involved. You have to give a return on that equity, form of dividend or earning per share, etc. Borrowed also carries an interest rate. Okay, so cost of capital is to know how much will be the cost to raise that money. All right, so there are different methods also in which, and the different capital requires a different way of calculating the cost. So say I am saying, for example, the cost of capital is 10%. Okay, for the company the cost of capital is 10%, and the return on the project for which I am raising the capital, when I am saying I am the company, so think from the company point of view. Your cost of capital, your company's cost of capital is 10%, and the need for that capital is a project. You are going to take the company capital and invest in project A. That project A will give you a return on that investment by 12%. So understood, yes, your cost is 10%, and when you will get the return, you are going to get 2% extra. Project should be accepted. But if it is vice versa, where your cost of capital is 8 and the return is only 8%, we will not take up that project. Return on investment has to be more than the cost of capital. Okay, so you had two modes, own and borrowed. In own we have equity and preference. In borrowed we have debentures and loan. Okay, these are only 4 things and cost we are going to study about. So process of evaluating the cost of capital, one example, one illustration. Okay, say a company has started the business with rupees 10 lakhs. Now how these 10 lakhs are there, they have bifurcated. Equity share capital is 5 lakhs, debt is 10% interest, 3 lakhs rupees, and preference shares is 2 lakhs. Preference share has 12% of cost, preference share dividend. Okay, so the cost also they have given to me. They have told me that cost is 20% for equity share capital, KE, cost of equity, we denote that by equity, KE. Cost of debt, we denote it by KD. Okay, and cost of preference share capital, we denote it by P. Okay, so they have already given me KE is 20%, D is 10% interest, we know only, so here 10%. Preference share is 12%. So each amount into cost, 5 lakhs into 20%, 3 lakhs into 10%, and 2 lakhs into 12%. When I will total that, my cost is 1,54,000 over 10 lakhs of capital employed. This will be my cost. Okay, so basically overall cost of capital with all these three sources together will be total cost upon the total capital employed. So it is 1,54,000 upon the capital, which is 10 lakhs. So it will come as 15.4% overall. Each we knew, 20, 10, 12, that we knew, but we want to know the overall cost of capital, which is denoted by KO. Clear? If you understand this, all the sums will going to become very simple. Okay. It can also be calculated with the help of weights. Now how? Say I have total 10 lakhs, again same example, equity is 5, debt is 3, preference share is 2. Assign the weights. Weights will be what? Each component, 5 divided by 10, this will be 3 divided by total, 2 divided by the total. So the weights are here 0.5, 0.3, 0.2. Correct? I will multiply that by the cost. 20 into 0.5, 10. Don't take percent. Here you write percentage. Okay. Here you write percentage in the cost column. But when you are multiplying, multiply it in this manner. 0.5 into 20, 0.3 into 10, and 0.2 into 12. Okay. When I multiply, I will get the weighted average cost of capital. 10, 3 and 2.4. Just add all of them. So weighted average cost of capital will be 15.4, which is same of my KO which I did in the first sum. Got it? Directly I got the answer because I got the weighted average cost of capital in form of percentage only. 10% plus 3 plus 2.4, 15.4%. In the last I put the percentage sign. Understanding? So this is cost of capital basic understanding, that how do we ascertain it. 3 sources, 3 different cost. We come to know the total cost, divide by the total capital, we will know the overall cost of capital. Or the most common practice is weights. With the help of the weights, you multiply that by the cost, you get the weighted average cost of capital. So project which yield above this cost, okay, only should be accepted. And if the project has a rate of capital return, okay, rate of return on capital employed is 12%, then it should be rejected. Why? Because our overall cost KO is 15.4, and if I am getting a return on capital employed only by 12%, it is way too less. I will reject the project. Clear? Okay. Now cost of debt. This was very easy sum, just an example I was giving you, that okay, cost of debt is what? The interest is my cost. Correct? But in debentures there is one thing. Whenever there is debentures or loans, I have explained you all this in the previous marathon also in capital structure, that interest gives us tax benefit. Okay, therefore KD will always become interest 1 minus tax rate. KD. Whenever I will calculate KD, if tax rate is given, I will ascertain my new KD. It will be interest 1 minus tax rate. Okay. If the face value is never given, we assume the face value always to be 100. That is face value, or you can say price. We always assume it to be 100. Interest always has tax benefit in that. Okay. So therefore calculation of cost of debt changes. It is interest minus the tax rate upon the market price if market price is given, or if we are not given, we take the normal face value into 100. So we say interest, actual formula is interest 1 minus tax rate upon price into 100, that will give you percentage. If the price is 100, 100 and 100 you get cancelled, so directly I write KD is interest 1 minus tax rate. Okay, but otherwise the formula is this. Okay, the formula remains interest 1 minus tax rate upon price into 100, you will get KD in percentage. Okay, if market price is given, we will take market price. Any of the formula is the same. Whatever price is given, we will take that price. Now there are certain debentures who they have to be redeemed. No, if the life of debenture is given, they are saying that the debentures are for a period of 5 years. Okay, so then there is one small thing involved in that. What happens is, when I issue debentures, my issue price would be different, say 100 as per my example. And when I am redeeming them, I am taking my debentures back and paying them off. I am giving them more money. See here, in my example, it is a 20. I am giving them 20 rupees extra. For what period was the life? 5 years. So then what happens is the formula changes a little. Okay, here the formula says KD will be nothing but interest 1 minus tax rate will stay. But there is an additional benefit they are getting. Additional benefit of 20 rupees. 120 minus 100. Over a period of 5 years. So that 20 rupees which they are getting for over a period of 5 years upon average price. So it is interest 1 minus tax rate plus the capital gain. I can say this is the capital gain. The whole thing upon the price. Now price I am taking average. RV plus SV upon 2. Okay. The formula remains the same. Interest 1 minus tax rate upon price. But here there is one additional thing, that is RV plus SV upon the, there is a capital gain which is involved. Okay. And average price I will get by adding this to divide by 2. Same with the cost of preference shares. Now in preference shares there is a dividend distribution tax which is involved. Okay. So here I will do preference dividend plus DDT. If it is given, DDT only if it is given. If it is not given, then there is no problem. Then it will remain preference dividend upon the market price. You will get that percentage form. And if the preference shares life is given, same thing I will do as I did in debentures. It will be dividend, preference dividend plus the capital gain. Redemption value is 98. Issue price, sale price. Okay, when I was selling as a company, when I was giving debentures, selling debentures, issuing debentures, it was 100 rupees. Okay, and then upon the average price. We will be solving the sums, so don't worry. Okay, you will understand the formula. Now cost of equity, it is the money which you get from the promoters. Okay, so you have to do periodic payment of dividend. Then there is a capital appreciation also. Market value of the shares increase. Okay, so this return is there. Then there are reserves which are there that also belong to the equity shareholders. So equity also has a way of computing the cost. Now cost of equity, 3-4 formulas are there. Important ones. Okay. First, basic, based on dividend. We give them dividend. Dividend is the cost for the company. So dividend will be, so cost of equity will be D1 upon the price. Or else you use the earning per share model. So you will say earning per share upon price. Then you can use dividend plus there is a growth. So in that case, I will say it will be D1 plus PO plus the growth. Okay. Now D1 means dividend now. Price we take off previous. Okay. So whenever there is a dividend D1, DO say is 5 rupees. And they are saying the growth is 10%. So D1 will become 5 plus 10%. 5.5. Now D1 will be 5.5. Understanding? And there is a CAPM model in which they say the risk-free rate of return. Cost of equity is nothing but the risk-free rate of return plus risk given in the market, difference between the market risk and risk-free rate of return multiplied by a beta. What happens in equity? There is a risk. In debentures, you know you are going to get interest. In equity, there is a risk factor involved. You are going to get payment during liquidation. Okay, return back in liquidation time. That also if the company is doing well. Earning per share, we don't know how much it will be. So there is a risk involved in equity market as compared to the fixed, like long-term debt and all that. Okay, where you get fixed income. So there is a risk factor. Risk factor comes with a premium. If I'm ready to take risk, I should get premium, no? So what is that premium? Premium is this: the return on market minus the rate-free return multiplied by that risk factor, which is beta. Risk-free rate of return I will get only, say risk-free rate of return is 10 and beta is 0.2. Market risk is I'm getting that 16%. So for the 6% extra I'm taking the risk. Na? In market I'm getting 16. Risk-free rate of return is 10. So for this extra 6% there is this 0.2 beta risk also involved. So here the KE will change. Okay, it will be 6 into 0.2. So 10 plus 1.2, it will become KE will be 11.2%. So this is also one way of solving the cost of equity. And the last one is reserves. Cost of equity and cost of reserves are generally same because cost of reserves is nothing but an opportunity cost. Okay, kind of. If opportunity cost is not given, no, they generally give it. Sometimes they do not mention anything. So we assume KE is same as KR. But if they have given an opportunity cost, I explained you all. What is opportunity cost? It is that cost which is involved when you keep your money idle. So reserves stay idle. So if there is an opportunity cost involved in that and they have given you specifically, you will take that. Otherwise, you take it same as KE because they belong to the equity shareholders. Clear? Okay. Price means for new issue is the issue price minus the flotation cost. Okay. Whatever is the issue price whenever I am taking P, in my formula, that is the price. Which price? Price for the issue price. Issue price minus flotation cost, if any. If it is there, you have to subtract it. For existing issue, we take market price. What are flotation costs? Like underwriting cost, advertisement, printing, all the, which will not be there, that you have to remove it from your issue price. Okay. Now weighted average cost of capital, as I told you, cost of debt plus equity plus preference share plus cost of retained earnings will give me weighted average cost of capital. So same thing I have solved again here. See, which we did know the first sum. Same thing is there over here. Value is given, cost is given. Total, my capital is 10 lakhs. I assign the weights 0.2, 0.3, 0.1, 0.1 and 0.3. Now see, there are so many sources. Equity, preference, debentures, loans and reserves. Okay, they have given me the cost of each. So 10%, 8%, 6%, 5% and 3%. Weights I calculated. Okay, component divided by total. It is component divided by total. When I will multiply this by the cost, weights by the cost, I will get the weighted average cost of capital. Weighted average cost of capital is nothing but the addition of all this 6.4%, that is the KO, overall cost of capital. Okay. Now cost of capital can be two methods. Book value method, when you do everything at the face value. All your price is at face value. Market value is when you are considering the market price of the shares. Okay. Or of the debentures or of the preference shares. And you are calculating the cost according to that market price. So see this. First basic sum we are going to solve. Let us solve these basics. A company wants to issue new 12% debentures. Face value is rupees 100. Tax rate is 25%. One, they want to issue it at par. Second, at a premium of 20%. One is at a discount of 20%. And these 10% discount, 5% flotation cost. Calculate the KD. All I have taken in one sum. First one is at par. That means price we know. Issue price. Par means 100, means 100 face value and issue price will be the same. So in my first case, I'll first write the formula. Interest 1 minus tax rate upon price. Interest will remain the same, 12% everywhere. Tax is going to remain the same everywhere. What is going to change? The P, the below price. Okay. So interest 1 minus tax rate divide by price, which is 100 in my case 1. 100 par. Par means same price. Face value and issue price is same. Into 100, this is 9%. Second, they are saying 20% premium. That means 10, 100 plus 20%, my issue price will be 120. So nothing. Only in my issue price I will change your price. I will make it 120 into 100, 7.5%. Numerator remains the same. It is basically 12 into 0.75 we are doing in the numerator. D, they are saying the issuing at a discount of 20%. So now here my issue price will be 80 because minus 20% for company issue price has reduced. So here it will be 12, 1 minus 0.25 divided by 80. Okay, I am getting 11.25 as my KD, cost of debentures. Last one is wherein there is a 10% discount also and 5% flotation cost also. I'll have to subtract both. So issue price will now become 100 minus 10%. This will become my issue price 90. From my issue price, I will remove my flotation cost. Important. Not from the face value. Okay, from the issue price I have to remove the flotation cost. Write down the note that flotation cost is subtracted from the issue price and not the face value. So first I removed the discount and I got the issue price. From there I removed the flotation cost and I got the actual price. That I will put it in my denominator and try to find out the cost of the KD. It will be 10.52%. Okay. Chalo. Next question. Again same. Company has existing debentures of 100 rupees. Currently they are traded in the market at 125. This is your market price. Coupon rate, interest rate is 15%. Calculate KD, tax rate is 20%. So interest 1 minus tax rate upon market price I will do since it is given. Interest is 15, 1 minus tax rate is 0.20, divided by 125, 9.6%. They are very, very simple sums. I have already solved it. Then also I am explaining you each point wise. Okay, there is cost of capital is one which requires like just the formula in the head and you have to just apply it. Nothing else is needed. And these are the basic sums. Okay. Clear? I'll move forward. Come on, give me a thumbs up or something that you all are with me. Okay. Next. Again some more simple types. We have to solve these simple types only because why they ask this only in the exams. Preference shares price is rupees 50 but its market price is 75. Coupon rate, dividend rate is 15%, tax is 20%. Calculate cost of preference. A. Again they are asking cost of preference if there was a DDT of 10%. Simple, no problem. Okay, first cost of the preference share A it will be what? Preference dividend. We know this, right? We know this formula, preference dividend upon the price into 100. That is my formula, market price. Now preference dividend is always calculated on the face value. So my face value is 50. Dividend is 15%. So 50 into 15%, market price is 75 into 100. I'll get 10% as KP. Right? In B, I already know my preference dividend. I don't need to calculate it again now. On price of 50 rupees share, dividend is 15%. I know it is 7.5. Okay, 15%. But there is a DDT involved, so I'll add the dividend distribution tax to this. So 7.5 plus 10%, 8.25. Market price will remain the same formula. Into 100, it will give me 11%. So if there was a DDT, my cost is 11%. When there was no DDT, my cost was 10%. Okay. Now see this. Face value is rupees 100. Company expects to give a dividend of 8 rupees and company will go at 7% per annum. Calculate KE. Expects to give dividend of rupees 8 means D1. Face value, price is 100. Growth rate is 7%. Okay, so how will we solve this sum? KE will be D1 plus PO plus growth. So first find this. I have put the bracket for you all and then write the growth. D1 is 8, price is 100 into 100. First find this and then add growth. Simple. So you will get 8%. First just find dividend upon price into 100 and then after that just add growth rate to it. So we have growth rate of 7% they have already given me. So it is 8 plus 7 which will come to 15. If you will do like this, you will never go wrong. What happens is some people know they do this. Okay, this so they have written, then 8 upon 100 plus 7% they will try to convert it 0.7 and 0.07 and then they will try to solve it from here and there. Nothing doing. It is very simple. I have given you all the trick. Simple. Solve this first. Whenever you are doing this growth model, no, D1 plus P into 100, just solve this first. Get this in percentage form, add the growth percentage to it, done. You are sorted. Okay. Don't try to convert into decimal and then take this number there and all. Don't make it complicated. Chalo, now weighted average cost of capital, again same. I'm going to take you all quickly to this. There is 10% debentures, 10% preference shares, equity shares, 5,000 rupees 100 each. Total is 10 lakhs. But equity shares are quoted at 102. Company expects to declare a dividend of 9 rupees per share. Tax rate is 50%. We have to calculate WACC. Okay, fine. I am writing the sources, debentures, preference shares, equity share capital, and I am writing the component 3, 2 and 5. Immediately, I will be able to assign the weights 0.3, 0.2, 0.5. Right? I'll find the cost first. For KD, now I have explained you all the formula. KD, it is interest 1 minus tax rate upon price. Interest they have given me 10, tax rate they have given me 50%. My KD now becomes 5% with the help of this formula. For KD, they have not given me any price. Assume 100. Nothing is given, assume price to be 100. Okay. Preference shares. Okay, preference shares nothing doing. Preference shares just directly put 10%. Same answer is going to come. Preference dividend upon price. Assume price if 100. So if I will do this, preference dividend is how much? 10 upon 100 into 100. 10%. So don't waste your time. Preference dividend DDT is not given. Nothing else is given about that. Okay. So just directly write 10. Now cost of equity we can do. Declaring a dividend of 9% they are saying, no? So KE will be what? Dividend upon price into 100. Dividend they have given me, market price also they have given me, into 100, 8.82. Put this in the cost column, multiply, get the weighted average cost of capital, add them all, KO will be 7.91%. Okay. Easy, no? So simple. Now market value weights. Market value weights, same thing. We will just find the source components with the help of the market value and then assign the weights. How? I'll show you. See, they are telling me compute the weighted average cost of capital using book value weights and market value weights both. Okay, now book value weights, we know how to do it. They have given me the structure: debentures, preference shares, equity shares, 8, 2, 10, 20. Recent market price of the debenture is 110, means face value is 100. Currently it is standing at 110. Preference share is at 120 and equity share is standing at 22 rupees. Cost of each component they have already given me. I don't have to find the cost. I have to find the weighted average cost of capital using the weights. First I have done the book value. Okay. Book value weights. Book value, it is simple. Okay, no, I have done the market value weights only directly here. This is the market value weights. How did I get this? Book value weights, you all can do it as a homework. It's the same thing like we did. So we have debentures, preference shares and equity share capital. How many debentures I have? Since 100 rupees per debenture, 8 lakhs rupees is there in debenture. That means there are 8,000 debentures. If I'll multiply that by 110, I'll get 8,80,000. Similarly with preference shares, 100 rupees per share, 2 lakhs rupees in preference share capital. That means there are 2,000 preference shares. Market price is 120. So 2,000 into 120, 2,40,000. And equity share capital, there was a 10 rupee share. 10 lakhs was the amount. That means there are 1 lakh equity shares. 1 lakh equity shares into 22 rupees, 22 lakhs. So total capital as per market value is coming as 33,20,000. Now I can assign the weights to that. Each component, 8,80,000 divided by 22 lakh. No, sorry. 8,80,000 divided by 33,20,000. I am getting 0.265. I am taking to 4 decimals. Similarly, 0.723, 0.6627. Cost, I don't have to do anything. They have already given it to me. This is given. Okay, this is just given. Multiply the weights by the cost. You will get weighted average cost of capital. Add them all. Weighted average cost of capital is 14.21%. Write down this solution quickly. I am giving you 30 seconds. And those who have already written it along with me, come on, let me know, reply. In cost of capital, there is nothing more than this, okay? You all don't have to worry about anything. This is all what they ask. So from exam point of view, I have covered it properly. You want to watch my detailed lectures based on all that other few more sums, you can definitely do it with the help of my dream batch. Okay? Alright. Come on, now taken some sums. See this. Shyamlal Limited is currently financed with rupees 5 lakhs of 10% debentures and rupees 15 lakhs of equity share. Equity share has a beta of 1.5 and the risk-free rate of return is 6% and the market risk premium is 4%. Premium is 4%. Premium means what? RM minus RF is premium. Tax rate is 20%. What is the weighted average cost of capital of this Shyamlal Limited? Okay, so I have to know first the cost of debt and then the cost of equity. Cost of debt is easy. First I'll find the cost of debt. 10% debentures, that means 10% is the rate of interest. 1 minus tax rate, 20% is the tax rate. Price is not given, I am assuming it to be 100. So 10, 1 minus 0.2 upon 100 into 100, 8% is KD. KE I'll find with the CAPM model. Okay, capital asset pricing model. RF plus beta into RM minus RF. This premium they have given me, additional premium. In order to go into the market and take the risk, that premium which I am getting, they have given me that. So it will be risk-free rate of return given. 1.5 is the beta into 4. This will become 12%. I know KD, I know KE. Weighted average cost of capital I have to find. Amount is given. Total is 20 lakhs. Weights I will find 5 lakhs upon 20 lakhs, 15 lakhs upon 20 lakhs. Weights is assigned. Cost I just found out. Multiply them. Weighted average cost of capital is 11%. These are also from your past exam papers only. A company issues 1010% preference shares of rupees 100 each. They are redeemable after 10 years at a premium of 5%. The cost of issue is rupees 2 per share. Cost of preference share capital is how much? First thing, my redemption price, when I am going to redeem, I am going to give it back. That time I am giving them a premium of 5%. So 100 plus 5% will become 105. And currently my issue price is 100 rupees, but there was a cost of issue involved. I have to remove it. All this flotation cost I have to remove. So my issue price is actually now 98. Okay, so I am going to use that RV minus SV formula because there is a life of debentures given here. Okay, so preference dividend is 10%. Here 10%. So I'll write 10 plus RV. Redemption value is 105. My sale value or issue price was 98 upon 10. Number of years, life. The whole thing upon the average price. How will I get average? Redemption plus sale value divided by 2. Okay. This whole thing into 100. That will give me, when I will calculate, it is coming to 10.54. Calculate it if you want along with me. 105 minus 98, divide that by 10. So your numerator will be basically 10 plus 0.7 and denominator will be 105 plus 98 divided by 2. 101.5. 101.5 into 100 percentage. So 10 plus 0.7 divided by 101.5%, 10.54 is the answer. Okay. Chalo, next. ABC Limited has the following capital structure. Equity share capital 10 lakhs, 10% preference share capital 5 lakhs, 8% debentures 15 lakhs. Cost of equity is 15%. Calculate the weighted average cost of capital assuming tax rate as 15%. ठीक है. Equity, preference share, debenture. Amount is given. I can just find the weights immediately. Each component divided by the total capital. 10 divided by 30. 5 divided by 30. Okay. And I can find the KD. Okay. Now I have to KE. They have given me it is 15%. Preference share capital it is already 5. 1 minute. 10 divided by, I think we have to change this, 10 divided by 30, yes, 0.33, 5 divided by 30, 0.16 and 15 divided by 35. I do not have to do anything for equity, they have already given me. Cost of equity is 15%. Preference share capital also I will directly take 10%. Only the cost of debt I will find over here because there is tax rate which is given to me. So interest 1 minus tax rate into 100 upon this price. So interest is 8, 1 minus tax rate upon 100 into 100, 4% is my cost of debt. So weighted average cost of capital comes to 8.67%. Okay. The capital structure of ABC consists of debentures, preference shares, equity shares and retained earnings. Weight of each security is given to me. The specific cost of capital is also given to me. I am supposed to find the weighted average cost of capital. Okay, everything is given. Cost is given, weight is given of each component. You will just multiply and add it and you will get the KO, weighted average cost of capital. So easy. Next sum. A company has issued 10,000 equity shares of rupees 100 each. Its current market price is 98. The current dividend is 4.5. The dividends are expected to grow by 10%. Compute the cost of equity. Now see, your current dividend they have given and dividend will grow by the rate of 10%. Na? The growth rate is 10%. So which formula I will take? D1 plus P upon growth. But they have given me D0, 4.5. To that I will add 10%. That will become my D1, 4.95. Price, market price is 98. Okay. Again over here this mistake has been done. So we will not repeat this mistake. We will do it like this. 4.95. Do it over here. 4.95 divide by 98. D1 is 4.95. Divide by 98 into 100. That will give me 5.05 plus 10. It will give me 15.05%. Okay. So this was it with your cost of capital. Okay. The detailed more, as I've told you, go ahead. Solve it now only from the dream batch. Take it up. Quickly solve it and finish it off. Okay. Cost of capital will be done. So working capital is over. Cost of working capital management, cost of capital is done. We finish with capital structure along with leverages. So many chapters. The other 2-3 chapters are theory which you can just read it. Done. And then more 2 chapters which are left. We are going to just take it up next time. So you are done with the entire FM portion. 40 marks. Okay. I have also for the June 20, for the December 23 attempt, there was this paper, the first new syllabus, that also I have solved. There is a video for that as well. You all can go and see that video. Okay, there are sums on weighted average cost of capital. One sum is there on cost of capital, 5 marks. Okay, and then working capital management is there. So once you are finished with this marathon revision, you can even go ahead and solve that paper with me. I have already solved and kept it. You have to just go and see that video, watch that video also. Okay everyone. So I hope all these formulas, if you know, you have understood the concept behind it. There is nothing which you have to do in cost of capital. Alright. So we are done with like good 20 marks of this entire FM. And with the previous marathon, I will say we have finished with 30 marks. Thank you everybody. Have a very good evening. Okay, and please revise, please solve more sums as you can. Okay, and read the theory. It will be very simple once you have solved everything with me. Okay, I will be doing capital budgeting and time value of money in the next marathon, which is on Friday. Okay, everybody is like very tensed about capital budgeting. But trust me, it is not that complicated as you all see it, because it is given like that in the module. If you have seen my sums and my videos, my lectures, it is really pretty simple, and from exam point of view, it is much easy. Okay. Chalo, see you all. Bye bye.